Good morning and welcome to Trade Live with IG with myself, Rich McDonald. On Fed Wednesday, we've got Ronnie in the house.
Happy to be back. Feels like I haven't seen you in ages, Rich.
Did you even know you were on this morning?
I absolutely knew about 2 minutes ago. I was made well aware.
So, you know when you were scheduled on yesterday and we said, why don't you and Pete swap over days? When we say swap over days, that means that you do when Pete was going to.
English is my second language, mate. I'm just a simple immigrant.
Now, talking about that, do we have any French people on the chat today? I would love to hear if we've got any French people on, because I am ready to bash the French. We haven't done it since producer Fred left, because I like to have a little joke with him. So we've been very nice to our French friends since, but they've picked a fight with me today.
Oh, really? What they done? Raise the price.
We'll get onto that later.
Raise the price of croissants.
Now, let me see. What have we got coming up today on Fed Wednesday? Of course, it's all about 7 p.m. tonight, but how are we going to get there? Well, it's you're here through to 8:35, my friend, so you better get comfy.
Yeah, that's what I'm doing. Opening bell, Rich McDonald, Ronnie Agnig, two Scottish boys representing. Then fast markets with us again, 8:15. Charting crypto with my man Axel Rudolph at 8:35.
Nice.
Next slide.
Oh, they're asleep in the gallery as well. What's going on today? It must be the weather. Angeline is coming in today. Good. So Angeline's doing 10 minutes of work today, is she?
Must be nice. Must be nice.
It's a great job, isn't it?
She's actually highest paid in IG if you look at hourly rates. Only work 10
on 10 minutes.
Annualized.
I reckon there might be somebody that still beats her.
Yeah.
Right, well, talking about two Scotsmen in the house, I had a wonderful evening last night, Ronnie.
Nice.
So I was invited to one of these Finfluencer events.
Oh, yes.
So it's all the good and the great of TikTok and Instagram, but it was with a company called 21 Shares. So they do the ETPs for crypto, and they've got 53 ETPs in total. ETP is just like an ETF, but
product instead of fund.
Yeah, a little bit more complicated, or it's just not shares. So anyway, we turn up and it's at the F1 racing thing in St. Paul's. So you actually get to go and sit in the car like you used to back in the day in Tempin bowling alleys, but race a proper F1 car on an F1 track.
Oh, that's very fun.
And there's 8 people in total.
How did you do?
So I came 10th out of 8.
10th out of 8.
There was 2 simulated drivers as well.
Oh, yes, nice.
So I managed to flip the car upside down, which was especially good.
Which car did you pick? Aston Martin, I hope?
No, they're all the same.
Oh, boring.
But yeah, no, you are in a team though. Anyway, it was great. The 21 Shares management were there. So there was a Scotsman called Duncan. And he used to work at Aberdeen. So we actually know my old housemate runs trading up there for Aberdeen Asset Management. And we're standing there. Anyway, Tom Slatter, the head of Finfluencer, he comes up to me at 7 p.m. He goes, Rich, we got 1 hour left of the event. We've got £3,000 behind the bar to spend. And there's only
Say no more.
There's only 7 of us left at that point, right? So it's like, at that, I'd been drinking sparkling water and Asahi Zero until then.
Rich,
It's a Tuesday night. Come on.
You've lost your grip, mate. That's not the Rich I know.
So Duncan from 21 Shares says to me, do you like whiskey? I said, I like whiskey. So we end up on the Macallan 25.
Oi.
Exactly. £50 a glass.
Gosh.
We didn't manage to spend the full 3,000.
How much did you manage to get through?
I actually don't know. I ended up leaving about 8:20.
You should have asked for it to go. Like, should I get 500 quid's worth in a coffee
I did actually
cup
take a bottle of wine. There was another one. I won't say exactly who, but Tom managed to get a few bottles, including 1 bottle of Ace of Spades that one of the people took home with them.
Shout out JC.
So it was a wonderful evening. And yeah, but really interested from 21 Shares. Obviously, they do the crypto ETPs. I was chatting to them about this October 8th change from the FCA. The FCA are going to let people invest crypto into their ISAs and their
Ooh.
SIPs. So this is big, right?
This is massive.
Because obviously Smarter Web Company, that was one way that you could get crypto into your ISA. But now you can do it through these ETPs as well.
Yeah, and you can, IG has...
Well, that was my idea, right? So obviously, suddenly, October the 8th, although it's more like the 20th by the time they get all the products through. Is the UK big enough to actually move the crypto market? And should we be getting a crypto account beforehand to buy crypto to benefit from the move higher?
You should always have a crypto account to diversify your assets, in my opinion.
Well, how do we do that, Ronnie? Do you know any crypto accounts on offer?
I do know. So at IG, you can trade leveraged and non-leveraged crypto. If you're a professional trader, you can trade professional only. You can trade on leveraged. If you're a regular person like me and Rich, then you can actually trade physical crypto. Means you can buy and hold crypto with us at IG, whether it be Bitcoin, Ethereum, Solana, whatever it be, or Bonk, as I'm a holder in.
We had a good conversation on Doge last night.
Listen, when Bonk goes to £1, I'm a millionaire. I bought 1,125,000 of them for £15.
You spent 50. You invested 15.
Invested £15.
And it's on the IG.
It's on the IG. Yeah.
Really?
So I got my account just to try it out, so I could provide great service for my clients and my work.
I walked away last night thinking, do you know what? I've laughed at Dogecoin for so long, but there's something in the US called the House of Doge, and 21 Shares are actually partnering with them. I must admit, it almost sounds it's like fake it till you make it in the case of Dogecoin, in that they are now actually making proper end cases for it.
Which is?
Well, the currency of social media.
Bruh.
That's their aim.
Moving on. Next.
Now, Gavin Ackers, what are you talking about? Bit like your fantasy league position.
Oh, how is my
Well, I'm trying to think what we've said this morning. Was that me attacking the French? Boston Frank, good morning to you. Andrew McKelvey. Barrett Redrow results out, and also Griffold. So we'll be talking about them before the Open. Morning to Ida Rock. Morning to Paul Williamson. Now, who watched Pete Ward yesterday? Did you see any of Pete Ward's show?
I only watch when Luke Moore is on because I'm a fanboy.
Right.
So unfortunately, I missed that one.
Well, this was the Pete Ward show yesterday. And he was on top of his usual sense of humor. Mm-hmm. One of the viewers noticed it, and one of the viewers sent a message. I've got to find this. Saying that, is Pete Ward the banter king? Now, I think it might have been Ida Rock. I can't remember exactly who it was. Let me see if I can find...
While you find it, I'll tell you a great piece of banter that Pete Ward said. So I was quite new on the premium desk. I think it was about a week or so in. And Mini Cooper, who likes to do a bit of shopping every payday. So he had come in with... so he obviously pays attention to fashion. And then...
Mini Cooper does.
Mini Cooper does. He's a very fashionable guy. So Wardy had come in with a new sweater or a shirt or something. And Mini Cooper says, "Oh, is that a new sweater, Pete? I like it." "Yeah, thanks. Your mom got it for me." And then everyone bursts out laughing. Mini Cooper's just sitting there like, cool. Can't really say much as his manager.
Mini. Well, here was the conversation yesterday with after Pete on the show. Donnie said, "Very much enjoyed Pete today. Mango, thanks, Pete." And Caught Short, sorry, said, "Is Pete the king of banter in the office?" Boise said, "Big time." And then David said, "Yes, he's like Finchy from The Office." Have you seen the show The Office?
Yeah. I do. I'm a bit offended because
Chris Finch from The Office.
He's a nice guy, funny guy. But I'm a bit offended that I'm not even in this conversation.
You're Gareth from The Office. That's who you are. Right, let's go into overnight action.
You charge me.
Okay, it is Fed Day, so we're in that anticipation. We're very excited about what's going to come up, but we do have a few things to go through.
Is there much of an anticipation? Isn't it just 25
Huge.
basis points cuts that is to be expected?
Right, you're getting the SERP, so you're getting projections for the next 2 years of where interest rates are going. You've got the big fight between Cook and the Trump-appointed guy that are both voting in it.
Miran.
Yeah, so there's going to be that tussle, and you've got Powell, who has obviously been berated constantly by Trump. What is he going to do? Is he going to choose some rhetoric in the press conference that moves away from that data dependence? This is big. This could be a proper. What you're saying is the market's not going to move because it's going to be a 25 basis point cut and everybody knows it. It's not about the cut. The cut's 25. We know that. What is the language going to be, and what are the projections going to be?
Very interesting. And what are your predictions?
My predictions are this could be it. This could be the high of the market for the year. This could be the day that we peak, and we might even go up, but it could be the biggest travel and arrive that we see in a long time.
Big predictions, Rich. Big predictions.
It's possible. I'm not saying it's going to happen, but what I wouldn't want to be is leveraged eyeballs long of American stocks tonight.
You don't want to be long.
That is the most dangerous. I think today is the most dangerous time of the year, apart from April the 5th or 7th, whatever it was, to be eyeballs long.
Sorry, I'm a bit confused here. You say you think that the market is going to go to the yearly high, but you don't want to be long.
Because it's the biggest travel and arrive ever, which means I think it could go significantly lower from here.
Okay, so how should one position themselves?
Risk off. Tonight
off.
is not the time to have risk on. Axel didn't even do a trade of the week this week because he's so scared and doesn't know what's about to happen next. You've got every chance that this is the top of the market.
You got every chance that it is.
Is it the time to take big risks going into tonight?
No, absolutely no. Absolutely no. I would never do that. Not even on the demo.
Not even on the demo.
Not even on the demo. That tells you everything you need to know. Risk off. No, I absolutely agree with you, because every word is going to be hyper analyzed, and any room for sort of interpretation can swing the market either way. So it's so difficult to take a position and have any sort of, conviction behind the position that you take, because it can go either way. I do expect, 0.25% cut, but what I'm really looking forward to see is, like you say, the sort of 2-year prediction on what it's going to be like. Because when is Powell, when is his sort of stint expiring?
May.
This year? Or next year? Next year, not this
Yeah.
year, just kidding.
Yeah, May.
Gotcha.
So we get the projections at 7 p.m. So 7 p.m. could potentially look hawkish, but then you might get more dovish press conference at 7:30. So the first move could be down, or will there be a celebration by the market that we get the 25 basis points cut? I don't know.
Interesting. What else are we looking at today?
Well, let's go through those projections. Let's see where they were last time we saw them. So June was the last time we saw these. Now, the federal funds rate March projection was 3.9. It stayed there in June. So 3.9 for the end of this year. That is expected to be, well, what are we? We're 2 cuts. So 50 basis points from here. 3.725, that should be. But what will this one be? That is the important number. If you're going to look at a number tonight, go straight there at 7 p.m. and see what this is, because that has to be down more like, well, let's have a look at our Fed watch. So December next year, December of 26, it's got to be somewhere in the range of 3.125.
That's quite bullish of you.
Well, no, it has to be. Otherwise, it's going to be disappointing.
Oh, it has to be.
It has to be. If it's not, then that's going to be a disappointment, no?
Yeah, absolutely. But it's
So that 3.6 number is the one to look at. If it is more than 3.4, then that is hawkish, and that is going to be a problem. And then you go out another year, you know, we're expecting more here, down to 3.0, and then the longer run to stay at 3.0. So this 2026 number of Fed funds rate, that's the one to watch. And unemployment, are they going to take unemployment higher than 4.5 for next year? Probably looks like it could come into 4.4 this year, maybe 4.5. But is this going to go significantly higher to more like 4.8? And that, of course, is potential stagflation.
well, which we've talked about quite a lot on this show, that they have sort of every sort of preset to have a stagflation, slowing growth and higher inflation. But what's interesting to me is that the longer run federal fund rate is 3%. That's the sort of new normal base rate. We're never going back to the sort of free money period that we had even before COVID, like when we saw with the Swiss central bank and the Swedish central bank, who experimented with negative base rates. I don't think we're ever going to see that sort of levels again, but no. I think 3% is a realistic. Let's see what too slow Jerome, as Trump likes to call
Too
him.
slow. Well, talking about too slow, producer Phil, let's get a poll up there. What do you think the Fed funds rate projection for 2026 is going to be? This 3.6 here, that's the important number tonight. Is it going to be 3.4, 3.2, 3.0, or 2.8? Are they going to go even lower and go 2.8? So this is the end, December next year. Where are we going to exit with interest rates of next year? The market is saying it's going to be 3%. So what is the Fed going to do? Fed unlikely to go as far as that, I feel, but you never know. So yeah, 3.4, 3.2, 3.0, 2.8. Let's get that poll up. Right. Now, should we go onto the front page of the newspapers?
Would long gold not be a good position tonight, even in the demo? Long gold is always a good position.
It's tricky, isn't it? Shall we have a look at the chart and see if we're still happy with that? Because it's
still.
We talked about it going to 3,700. It's been very close, hasn't it?
Yeah, I mean we're just edging on there.
So
when will we see 4,000 gold, Rich?
Oh, by the end of the year, I think.
I 100% agree with you.
Yeah.
4,000 gold by the end of the year, without a doubt. But my question to you is, what will trigger it?
Well, a higher inflation number, which I think we probably get in November, and people wanting to exit. I think the continued sort of marketing of the idea of buying gold, right? Because retail haven't really got that excited about it yet. They're still in crypto, they're still in S&P 500 or Nvidia, Palantir. None of them have started getting into gold. And that could be interesting.
So if retail traders start getting their gold exposure, that's when we see the sort of 4,000 catalyst.
I think so.
I mean, gold has always been a sort of like safe haven, agreed upon safe haven.
Yeah, but it's boring.
It is boring.
It's boring to make that much money. Eh? It is boring for your money to always go up and up and up and up and up like that. They don't want that. They want Palantir. They want 100 times sales.
They want SWC.
An SWC that goes up 50% a day or down 50% a day.
Keeps you young.
Yeah, gold, you know, it moves 0.3, 0.4% a day. It's not sexy enough for them, Ronnie.
I agree. That's why they tune in to watch you every morning.
It's so. So is gold going to go to 4,000 by the end of the year?
Can we get a poll? Producer Phil, can we get a poll? We already have a poll going.
We got to wait for this one first, I think.
Sorry, mate. Sorry. Got too excited.
So yeah, gold tonight. But yeah, let's take a look at the front page of the Financial Times. There he is. Trump is here. He's on the ground, Ronnie. You going to go and see him today?
Over my dead body.
Right. But he's bringing all this money into the UK. $50 billion he's brought now via Microsoft, Google, Nvidia.
Yeah, and how much has he taken from us with tariffs and...
Well, 30 billion. So that's the other story of the morning, is that Glaxo have been strong-armed into investing 30 billion into the US.
Glaxo amongst every other company in the world, almost, it seems like. Careful now, Glaxo. You might have your plants raided, like Hyundai did.
What happened there?
So yeah, they set up. They invested a bunch of money into building an EV plant in the US.
Right.
And then the immigration services came and raided the plants for sort of unauthorized workers.
Unauthorized as in illegal, or?
No person is illegal. That's all I'm saying. Socialist Swede is back at it. But hey,
is Melania really wearing Burberry? Good touch. Is that right? It is, isn't it? It's a Burberry Mac. Well done. We never checked on tariffs on Slovenia. Did he dare? I bet he didn't. America pays Slovenia 10%.
I have a very inappropriate joke in my head, but I'm not going to say it. That's where it's going to stay.
Right, so what stories have we got in the FT today? We've got UK watchdog potentially downgrading productivity forecast. Not good. Not good at all. That puts further pressure on the doomed Chancellor Rachel Reeves.
How long will she survive?
Oh, until about 24 hours after the budget. It's so obvious what's going to happen. She's going to have to deliver terrible things, which everybody's going to be annoyed at, and then they go, okay, sorry, Chancellor's got to go, it's all her fault, and then you get a new Chancellor.
Who keeps the budget?
Who keeps the budget?
Because they realize that's the things that actually need to be done.
Yeah, you got to feel sorry for her, actually.
Could be worse. She could be the French PM.
Right, so on the topic of this, let's have a look at the fund managers shunning the UK as investor exodus hits record high. Yet again, the FTSE has become a net 20% underweight position, right? And it's at its lowest point.
And they're classifying Britain as an emerging market.
Now, talk to me.
I mean, that's a bit outrageous that it's an emerging market.
Give it to me, Ronnie. Like, read out the part of the.
Well, last time I read something out on this show, you roasted me for saying that.
No.
Okay.
Let's go on.
UK assets are the most unloved assets right now, he said. Investors are now almost considering the UK as it was an emerging economy.
Says a Frenchman.
That is outrageous. Their bond spread is on par with Italy now. That is outrageous. Listen up, you Frenchmen. Keep your pret. Keep your croissants. We're not an emerging market. This is the country where industrialization started.
And golf.
And golf.
And whiskey.
And whiskey. And Aberdeen Football Club. So
emerging market.
That is
if they had said outrageous. Scotland was like an emerging market, I would have almost taken it.
Yeah.
But calling the UK an emerging market, I had to look into this. So Elias Galou, he's not even French, he's Algerian. Now that's a proper emerging market.
Yeah.
Which you could say.
Careful now.
Which you could say, if he's Algerian, then he knows what an emerging market is. Therefore, he's got more right to call us out.
Takes one to know.
But still, he's never even lived here. I thought it was a Frenchman that was still angry at Brexit. But it's not.
Come to Whitechapel and I'll show you what a progressive country this is and how we're leading the charge. That's outrageous.
So is that where your girlfriend's penthouse is that you joined us from the other day?
I will not disclose the penthouse location of my lovely girlfriend, but she's balling.
So yeah, so that's my rant against the French. Elias Galou of Bank of America.
Whose word are we going to take?
Producer Phil's inviting him on the show, but he can't because he's in France. He's never been to London, so he doesn't know what a fantastic country this is.
Yeah, he doesn't know, and he's not welcome. He's not welcome either. He can tune in. He can tune in from his desk.
Emerging market.
Whose word are we going to take? Some random bloke from Bank of America or Larry Fink, who said, the leader of the world's largest asset manager, who said that UK is the most exciting market with the undervalued assets.
And that he was buying it.
He's buying it.
Yeah, there we go. And he's got a lot more money to buy it because he owns 41% of Oracle. And that stock...
41%?
41%. Is that right?
Larry Fink.
That's right.
Does BlackRock own 41%?
Oh, no, sorry, Larry
Ellison.
Yeah, Larry Ellison.
That's borderline racist, mate.
Get your Larry right. Right, it is 7:56. It's time for chart of the day. We are going, hopefully not to France after all that. It's a UK, there we go. Let's see this emerging market stock.
Woke up late with the market live. Charts on my screen doing 9 to 5. I made a coffee with a nervous grin, cause I got no clue what shape this thing's in. Rich says bull, but Ange says wait. I'm zooming out just to contemplate. Is it Netflix? Is it Shell? No one knows and I can't tell. Guess the chart, come on, take a swing. It could be gold or a Burger King. One big move or a sideways slide. We don't know, so guess the chart. We don't know, so guess the chart. I drew a line, then I moved it twice. Tried Fibonacci, but I paid the price. I even asked producer Phil. He shrugged and said it's vibes and will. I hit long, then I hit reverse. My trading plan is get rich or worse. It looks like meta, it feels like coke. Could be dog food or just a joke. Guess the chart, come on, don't be shy. It could be jets, it could be right. Might be oil, might be retail more. Let your gut just guess the chart. Let your gut just guess the chart. Bridge time now, I'm feeling cursed. Every trade I make just makes it worse. But I can't stop, I've come this far. I'm in too deep to guess who you are. Guess the chart. Yeah, I'll make that.
Great, welcome back. 7:59, so we've only got a minute till we go. Andrew McKelvey saying UK is not an emerging market, it's a submerging market.
You know what? I think I agree with that. I'm not quite sure what he meant, but I agree with him. But
It's been
the
underwater
chart,
for a while.
I've been doing a lot of thinking in the chart.
Yeah.
Regarding the chart. And I think the chart is next.
It is next. Well done, Ronnie.
Thank you.
No help from Gavin Ackers there at all.
Yeah, and Tom Roberts definitely didn't text me on Teams to let me know that it was.
I do, Tom. Thank you, Tom, for tuning in.
That's a true team lead. Always back your people.
They're probably laughing at you after trying to match Pete Ward from yesterday. Right, get the bell in your hand. Oh, I've got it. Brilliant. I'll do it. Thank you to our good friend up in Nottingham. What have you done to it?
That is.
What on earth have you done to the bell? I don't
is-
care if it's blaring the audio. You can't. They've dumbed down the bell, Ronnie.
It's underwhelming to say the least. But
I've got it. There's your
you-
microphone. How's that?
I'm sure you're used to performing. I'm sure you're used to providing underwhelming performances. So here we are. They just want to make you feel comfortable, mate.
London Stock Exchange. How are we going to get sponsored by London Stock Exchange if we can't even ring a proper bell?
Yeah, especially after we're starting a war with Algeria and France over our support for
Not
the
just
London
France.
Stock Exchange.
I love my Algerian brothers.
Yeah,
I'm just
me
saying
too.
that's a frontier market.
That's 100%. Yeah.
Although frontier does sound better than emerging, doesn't it? Right, what are these stocks in the emerging markets top index doing today? Well, Centrica, Vistry, Barrett Redrow, there it is. Barrett's up 50 basis points after those numbers. We'll look at Griffold in a minute. Berkeley Group, well, you can see there's a bunch of stocks up about 0.5% there. Nothing really standing out. It's going to be a quiet day ahead.
WPP is up, and Scottish Mortgage Investment Trust, one of my personal favorites.
Intercontinental IHG up 1.4. JD Sports, Ronnie's favourite shop.
Listen, when JD Sports hits 100, hits a quid, I'll come to the show with a JD Sports bag.
No, you got to do more than that. With a bag, wearing a bag.
Yeah. What do you like? I'll show the
Right. Okay. We are going to get the staff of JD Sports have a T-shirt with JD Sports in it.
Okay, if you can get one of those, I'll wear it when it hits.
I'll get one. Don't you worry. Right. Aberdeen, our good friends without any vowels, still on our platform. Are they going to fix that?
They've changed it. They've changed it back.
Yeah, exactly.
Please, respect the greatest asset manager and city in the world.
Up 70 basis points. What's on the downside today? The downside is Fresnillo giving up some of the gains, down 2%. Again, well, I'm not even that confident that gold can stay as high as this in the short term. I would think all assets go down after tonight, but then some rise like a phoenix from the flames, which will be gold, and some struggle to continue.
Will gold drag the sort of miners with it?
The gold miners, yes. Now, let's do the calculation here. If what we're saying is the market expectations for rates is down here, right? Yes, rates are coming lower, but the Fed will only promise around here. So it's a hawkish. I think it'll be dovish rhetoric, but it won't be as dovish as the market wants. So therefore, the dollar strengthens from that. Because at the moment, the dollar's crashing. Sosnoff was talking about it on Tasty last night. The dollar is crashing. Now, if the UK is such an emerging market, then why is our currency so strong? Well, it's strong because of that weak dollar. So I am tempted to short cable. Short cable means that the FTSE should outperform, but it should mean that commodities go down. So therefore, the miners will underperform the FTSE 100. So the idea would be to go short mining, long FTSE.
And who will
if all that plays out.
Interesting. So the miners, who are a big part of the FTSE, they will fall. But who will be the biggest winners in the FTSE? Which constituents will be?
It will be the defensives, won't it? Because if you're getting a high beta sell-off, then money usually goes somewhere, and it will go into those British American tobacco. Where's BATS? So utils, tobaccos, and potentially high dividend names. Yeah, the high dividend pairs.
The legal generals of the world.
A little bit too on the risk side. More like your SSE pays a decent dividend. Vodafone, jokes aside, could actually be a... you want things that have got safe dividends that are defensive companies. That's what I would imagine you would want in the case of a dollar positive Fed.
Interesting take.
Yeah, it's tricky to get into a. But yeah, long, strong dividend names, long FTSE, short Nasdaq.
But long, strong dividend names, isn't that always a tactic, especially for, you know, the sort of defensive ISAs, you know, and the FTSE itself, like the UK market and the FTSE 100 is specifically made up of companies like that.
Yeah.
It is an ideal index for that sort of performance.
You just want to strip out the risky things. So,
Okay, so Rich, I've taken risk off.
yeah,
I want to put some money in. I want some strong defensive names without, pardon me, without going for the risky names. Give me 5 names I should look at.
National Grid, British American Tobacco, SSE, Vodafone, and I'm trying to think one a little bit different. Well, let's put it over to you guys. What do you think that 5th name should be? What would be your top FTSE name in a scenario where the dollar is strengthening? We've got a global equity sell-off, but the FTSE does outperform because cable will be selling down to 134. And we're looking for that defensive name in the UK, one that's probably not already gone up like 30%, like a Tesco. Tesco's at £4.40. So what would it be? Lloyd's, yeah,
Lloyd's, great. Yeah.
potential.
Yeah, you get some Lloyd's, call us in 10 years, ask us how it's doing, and we'll tell you it's where it was 10 years ago.
Unilever.
Unilever is interesting, especially now with the spin-off of the ice cream business.
That's been frozen, hasn't it?
No, they're going.
Shall we go to break? You can walk out if you want.
Yeah, I'd really love to. Boncoin is the one you should put your money in.
Funky Gibbon.
Just kidding. That's not advice. Don't put your money in Boncoin.
Glaxo. AB Foods, well, Primark's had pretty bad results, hasn't it? BP, oil price. I'd struggle to know what the oil price would do, but I agree. Any of these.
I think BP
This is why the
actually,
FTSE is so great, because you
Yeah.
could name 10 stocks that we
You know what?
buy.
Jokes aside, I'm with Jugger on this one. I think BP is the most interesting one, especially with the Elliott management entry. I think they really narrowed down the focus of the business. They leaned out, and they're now going to be very, very impressive coming forward, and they're going to close that gap to Shell.
What shall we sell? So, because I'm actually thinking of putting this on. If I put this on and buy the 5 stocks that we've decided, do we dare sell the Nasdaq? Do we sell the Russell 2000?
I would rather sell the Nasdaq than the Russell 2000.
Yeah.
I think the Russell 2000 offers more diversity. It's going to be more defensive in times like this, and it would be a logical option to sort of switch your allocation to from the Nasdaq, which is very tech heavy and has been taking quite a beating lately.
And if you're talking overowned, then there's actually, we should check our friends at Bank of America and see what they say is actually overowned, because they're saying the FTSE's underowned. So is Unilever, Marks and Spencer, I love all these ideas. Sell Google, sell Micron. Yeah, I really like that. You could just do simple short Nasdaq, long FTSE.
Could do. That's.
I'm going to buy some FTSE because I've talked myself into it. Let's get invested in this emerging
Like a true
market.
patriot.
So 9,210 we're buying. Let's see. So 3 contracts is £6 a point, because I trade the £2. Ooh, £2 a point, Ronnie. So buy 3 of those.
Live a little, mate.
I'm already short the Nasdaq. So that's going to. And let's wait and see. But I do like some of those names. Marks, Unilever, BP, BT, Lloyds, SSE, National Grid. What's yours?
I would go BAT,
BAT, yeah.
BAT, BP, Associate British Foods.
Oh, yeah. Mm-hmm. Okay, nice.
I'll go Greg's.
Jeez, now we're...
I'll go Greg's. I like Greg's.
You'll go to Greg's.
I love a bit of Greg's. And
£15.80. Look at that. There's Greg's now.
that's a bargain, mate. That's a bargain if I've ever seen one. And then in addition, I know we said risk off, so I'm gonna go. I was gonna say Scottish Mortgage Investment Trust, but that's too risky.
Oh, there's a short.
Don't
There
say that.
is
Don't
our
say that. I
short
just recommended it to
Scottish.
my future father-in-law. Don't say that.
Up 72 basis points. Right, there we go.
Keep it going up, mate. Don't do that.
Okay,
Don't do
okay,
that.
okay. But certainly, if we wanted just to do the short Nasdaq through a UK stock, then that would be the one, right?
100%, 100%, because that is the most tech exposure you can get, American tech exposure, especially from a UK investment.
Definitely. European. Let's look at Europa.
Short everything France.
Where's the strength today? Well, the strength's in Rheinmetall. It's back up there, people.
Mate, that is just...
Oh, I've got my Wisdom Tree European Defence.
And look at those two. We got Puma and Kering. They're both up.
Now, there was bid rumours around in Puma yesterday. Stock was up 4.5%.
Yeah.
Guess who the suitor was?
Kering.
Adidas.
Whoa.
The brothers to get back together.
But that's why Kering is up, because they own about 20% of the company.
Of Puma.
Yeah.
Do they really?
If I'm not mistaken.
So Adidas potentially looking at Puma. Saw Puma rally 4.5% yesterday. Do you think that's a good deal? I don't know if Adidas need it. They only just got rid of Reebok a few years ago. Why would they go and jump into bed with another underperforming brand?
I wouldn't touch Puma. And my apologies. Seems like Kering sold out of Puma in 2021.
Okay.
Where they held as much as 86% in 2018.
Wow.
That's a bit of a shocker.
Yeah.
But yeah, the
on the downside in
Europeans.
Europe, nothing much there. Seems Nestle. Now Nestle has lost its chairman.
Oh yeah. Seems like he couldn't keep his hands out of the cookie jar.
No, not the CEO.
Oh.
The chairman's not at it as well, is he?
You never know
Surely
with the
not.
French.
No. The Swiss.
Swiss, hey.
It's French.
Bada bing, bada boom.
Nestle losing their chairman this morning, 71.60. The stock down 30 basis points. That has been a fall from grace. Let's check the Nestle. Look at that. It looks like a Toblerone mountain range.
Toblerone. It's just Nestle. It's just not interesting to me.
Look at that's terrible.
Oh,
Well, you think the French luxuries are bad.
yeah.
This thing has not. What have they done wrong?
Theoretically speaking, if you look at a company like Nestle and you think just theoretically, you'd say this is a company that will perform well in all weathers. They are basically they are the biggest food company in the world. They own 60% of every shelf in a grocery store. Everything that you buy is almost Nestle, but it's just constant underperformance. And the reason for that, in my opinion, is just, which they now realize as they're starting to divest and having a leaner operation, is they're such a too big of a conglomerate that they're moving at the pace of an oil tanker trying to turn around.
Yeah.
And also poor management.
Well, that's it. They need new management. They need to get a few smarties in there. But the graph reminds me of Diageo. You know, that is, these stocks back in 2021 were the heroes and Diageo, Nestle, those defensive companies, to really lost their way.
They lost their way because they're sort of, because the sort of market shift, the consumer trends are shifting. They are shifting away from the sugary drinks, they are sugary foods, they are shifting away from the alcoholic drinks.
Yeah.
But these companies are moving so slow because there's such, bureaucracies involved in these companies, and getting something done is 1,600 different committees. They're moving too slow, and they're not making the right acquisitions in order to position themselves to benefit from this.
Boise, SWC back at £1, is that right? Talking about falls from grace. Look, it is as well. £1 to £1.05. Whoa. So another conversation I was having last night was around what you can do with your Bitcoin.
that's moving. But first of all, just wanted to talk about a huge event that Mo and I have been watching. Mo, we seem to be synchronized here. If you're on the show, do give us a wave. But the other reason why we should all be careful in Fed week, and you heard Rich talking about, diversification. You've heard me talking about my money still sat on the sidelines waiting, is because this Friday, what is this Friday? Go on, Ronnie. Other than your hot date.
Other than my hot date.
This Friday is huge because, for the markets, because it is...
You tell me.
Witching Friday. And this time round, correct me if I'm wrong, friends, I think it's quad witching, not triple, I think it's quad witching, and it might be the biggest options expiration in history.
Right.
Right? So it's going to be
I knew that.
Huge. It's going to be
I knew that.
Huge. Be careful. Have your gloves on. And this might be, Mo and I were just chatting offline, this could be the moment that everyone, including Rich, has been waiting for. So just to give you context, it's expected to be the biggest options expiration in history. A handful of financial instruments that are likely to be very volatile. The usual suspects, Nvidia, Tesla. It's going to be $1 trillion expiration. That's the expectation, with so much open interest needing to be acted on. So make sure you have that in the corner of your eye. Let's have a look at, and I'll also post how to be ready for it and how to trade it as well on the chat after this. Let's have a look at some of the movers. There's still risk on there, although flat now, has to be said. We've got loads of people on the chat too. Galliford Try, one of the ones that Andrew McKilvey was looking at this morning. Any of your clients like Galliford?
I've actually never even heard of them, so I take that as a no, because my clients haven't traded this one. For the people at home, not me, obviously, because I know about them. I know about every stock on the IG website. But for the people at home, Ange, can you tell me, what does Galliford Try do?
So let's take you through the numbers first. So Galliford Try Holdings, it came out with numbers about an hour ago. Full year revenues at 1,875 million. If you look at the chart as well, just take us through. We always say take a look left on the chart, because I'm going to get up the broker upgrades and downgrades. I'm going to move this to the weekly chart. What do you think of that chart? Do you like that chart, Ronnie?
I mean, yeah, who doesn't? Especially if you got in at the bottom. While I have done my research now on ChatGPT, and I've realized that Galliford Try is a construction company.
Yep.
I think that is an interesting take to look at, as the UK is very heavily focused on increasing construction and removing red tape in property development. So that's an interesting take.
I was also checking to make sure I didn't misquote this, but it is a combination. And Andrew, you're very knowledgeable in this sector. I know, Mo, you also have a career related to construction. It is a marriage between Galliford and Try. The stock action has been incredible. Look at that very strong upward trend there, which is actually, part of the reason why a lot of people that I know have this in their defensive portfolio as well. Taking a look at some of the other stocks that we are seeing moving higher. Let's take a look at, I think someone mentioned AstraZeneca. There we are. AstraZeneca is down 0.75% there. Let's see, I don't know what the news is around Astra. Well, it's asthma drug, Fasenra, which failed to control the rate of flare-ups in patients with smoker's lung.
Boring. AstraZeneca is a great company, especially now as AstraZeneca is one of the biggest holding of the Swedish company Investor. who have launched a massive partnership with NVIDIA to build supercomputers to utilize the data that they have. And AI and sort of supercomputers is something that's going to be game-changing in the medicinal industry, as they'll be able to sort of simulate and predict all the different kind of proteins that the human body needs in terms of healing. So AstraZeneca is a long-term buy for me, and I think it's a really, really interesting company. They're a bit undervalued with the troubles they had in China, etc., but buying opportunity more than anything in my take.
Moonpig.com. Do you use them very much?
No.
Well, maybe you should, because they are up 6.3% right as we speak and gaining ground. Moonpig, seeing this action here. Let's give you the daily chart, friends. Yeah, we are. Everyone's singing in the gallery now. Hopefully you are too, where you are sitting and watching this. The hourly, let's see, 15 minutes. There we are. That's the best chart to illustrate that move. It is starting to plateau now, but it is still up 6.8%. This is after the company says it is on track to deliver guidance. You know who uses Moonpig on the desk?
Who?
Mini Cooper.
Really?
Yeah. Mini Cooper. So this is one that's a nice one to watch from a technical viewpoint. This is the daily chart, friends. As you can see here, we saw a nice floor, right, at around 190. And this, I love this, I love this. Take a look at this. I'm going to draw a horizontal line because we talk a lot about bag holders, right? But how about interest? So putting that yellow line, and just yellow line that you can see that every time it touches the yellow line, there is interest in the stock. And right now, we have bounced off that line again. We're starting to see strong green candles there for lots of consecutive sessions. 1, 2, 3, 4, 5, 6, 7, 7 out of 9. So we're seeing momentum there. And what I'd like to see from this chart before entering is for it to clear the 100-day moving average. Once price action is above the 3 moving averages, then we are on a momentum call there, Mo, if you're listening. Nestle, the other one that I was watching outside, just bear in mind, Nestle is looking like it's reversing right now. Any others that you are seeing that you like, Ronnie?
Yeah, so companies that I've looked at that I think is...
Eutelsat might be moving as well, whilst you're getting yours up. Okay,
yeah.
Eutelsat is down more than 2% there, and this is after Alpha Value cut the stock to add from buy. So very quickly, we've got Axel waiting the wings. You were talking about diversification earlier on.
Yes, I was.
So I have been diversifying whilst waiting. I've been waiting 6 weeks now, people, to figure out what to do with, some of the funds that I have waiting. When I get FOMO, and everyone does, unless you found a way of not having FOMO, it's quite hard, but I found the best way is to create yourself a list. And this is Angie's diversification list. So whenever I feel FOMO, I feel like, oh my goodness, they're talking about CoreWeave again. Oh no, they're talking about Broadcom. I really feel like I need to, make that position larger or, enter. I then say, wait a minute, I still have to remain composed to wait for a good entry point. And right now, maybe that quad witching on Friday, we're going to see maybe markets tank there and it's time to get in. Maybe it could be later today or tomorrow, depending on what the Fed says. Maybe Jerome might have a drop mic moment. I don't know. That's all not real. Those are all theories, right? But when I have FOMO, I then look at my diversification list. And there you have it. So we have Eli Lilly, just because I think it has a better proposition than Novo. But your BPs and Shells, you talked about BP earlier, your Glaxos, Relics, Rio Tinto, National Grid, and of course, Berkshire Hathaway and Goldman Sachs. Right, we gotta go because Axel is waiting in the wings. Thank you so much, Ronnie.
Thank you.
When are we gonna get invited to the penthouse?
The penthouse of my beautiful and lovely girlfriend's house is off limits for IG people.
All right, but they're contractors, they say.
Oh, yeah.
On that note, I'll send our trader friends the invite to you on Discord because they're not IG people. Axel's coming right up with how to chart, this specifically to do with crypto.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Hello and welcome to Charting Crypto, and let's get straight into it and look at Bitcoin. And we can see here that we've been rising over the last few days, even though we had this minor consolidation phase here where we just traded sideways since Friday. But you can see here that we're still pushing higher. And that is interesting because yesterday, for example, in European equity markets, we had the sharpest sell-off for several months. The DAX falling over 1.5%, for example, in Germany. And even US markets just coming off slightly below their record highs ahead of today's FOMC meeting and Fed decision at 7 p.m. UK time. But cryptocurrencies do not care. They're actually going higher in anticipation probably of that rate cut that we're expecting, 25 basis points later on today in the US. Now, what we can see on the Bitcoin chart is that we are basically testing
that high from the 22nd of August. Now, this is important because you can see it was a big candle off this support area here. And then, yes, we did fail, but that is, because it's a big candle, a really important level. So if we manage to close above there today, then it looks actually as if we could continue to head higher again and probably reach the $120,000 mark or even higher than that. So basically, Bitcoin, to me, technically speaking, still looks bullish, provided it stays above its Monday low from this week. And that was made at 114,399 or just below there, because that's the last reaction low. As you know, I like to look at reaction lows, reaction highs. So what we've got here is this support line and this reaction low. And if you look at it today, they more or less come in at the same place, around $114,265 or so. So as long as we stay above there, we've got an uptrend, higher highs, higher lows that we've seen since the beginning of the month. And it looks as if we could break through this resistance area going back to the 22nd of August and then continue higher, as you can see here, towards the $120,000 mark on the Bitcoin chart. Now, basically, if you are bearish or if you hold short positions on Bitcoin, then, well, you probably need to have a pretty tight stop above that high on the 22nd of August. If you don't want that, maybe you can place one above the next relative high here, the 17th of August high. But right now, as I say, technically speaking, the chart looks bullish. Now, if we look at Ethereum, because that's also very interesting, and please send your questions in on whatever cryptocurrency you are interested in. You can see here on Ethereum, we talked a few weeks ago about negative divergence when we made a higher high on the Ethereum price, on the Ether price, but that wasn't reflected by the relative strength index. And we then had this consolidation phase lower taking shape. But what is interesting at the moment is that basically we remain within this uptrend line, and we actually bounced off there yesterday. And this negative divergence is most likely now gone, because basically, as you can see here, if you look at the relative strength index, we've broken through that downtrend line on the relative strength index and rose above the previous high. So when that happens, you can just ignore the RSI negative divergence and consider that the trend continues. And the trend, as you see here, was pointing up. We had really, really good support going back to the levels seen here in March of 2024, and then also in December of 2024. And that acted as a support here on the 20th of August of this year. And we can see that we remain above the uptrend. Now, if we were to fall through this uptrend line and through yesterday's low, which was around $4,426, then perhaps we could drift lower. We could still trade sideways in this low volatility trading range we were in above this support area. But basically, as long as this major support area here holds, from a long-term perspective, the trend is your friend, is still pointing higher. All we're doing is trading sideways below the August highs, but still with bullish momentum. Now you might say, yes, but we've come off of the last 4 days, which we have. But can you see how the candles were relatively small compared to the previous big candle here? So basically it took us 4 bodies here, 4 days to get back to the low of that bullish candle. And as long as we stay above that bullish candle and these lows, as I just mentioned, basically for me, the fact that we're still in an uptrend is more important than this drift lower, because basically the move up was fast and then the counter move was slow. And what you want to see is fast moves. If you see something like this, for example, a fast move up, slowing momentum, then fast move down, that's a different story. But we haven't seen that. We just sort of drifted lower. So for me, we're still looking bullish on Ether ahead of today's FOMC meeting. Now, if we were to fall through these lows, as I say, we'll probably just sideways trade. So really, it would need to be a fall through the 1st of September low. We had $4,214 per Ether that we would start to think, well, maybe we might retest this support area here. So if you're short, your stop loss is probably above the high seen on the 13th of September. If you're long, longer term, you basically stay long as we stay above this support area here, and short term, just below the uptrend line. Now, I've also got questions about Solana, Sol, and let's look at that. And you can see here, we basically broke out to the upside, had a new high there, and are still looking very bullish. I mean, you've got these support lines going back further down. I've only had 2 touching points. That's why they're dashed. We broke out of this triangle formation here to the upside. Very nice technical charts. And right now, all you can do is really draw in another accelerated support line here. And basically, that's just holding. So here, the story is still bullish. If we go onto a weekly chart, you can see that we are heading up again towards the highs seen in November of 2024, towards $264. You can see we had a very sharp up move here in the first week of September. That's bullish. It's normal for us to consolidate a bit. And then usually what happens is we just continue. So from a daily chart perspective, if you look at Sol, you can see that we remain bullish. We have a series of higher highs, higher lows. Unless we were to fall through the low seen on Monday, and that was made at $230 or just below that, just above there. As long as we stay above there, it's fine. If we fall through there, we would have fallen through a support line and the previous relative low here, because that's lower than the one to the left and to the right. In that case, we could see a deeper correction, perhaps even take us back down again towards the late August high here around $218. But unless that plays out, the trend is your friend and is still pointing higher. And so Sol for me is still a bullish chart pattern here. Now, if you're short here at these levels, well, your stop loss is probably above the last relative high here, and that was made here $249.68 on the 14th of September. But most people are probably long, and there is no reason to get out of the longs based on this chart. Now, Doge is also interesting. Let me just put that one up here, because it's trying to get more and more acceptance. Let me just make sure I've got it on crypto here. Oh yeah, I've got Doge on already on here. Sorry, there it is. Here we go. And basically, Doge broke out again out of this triangle formation, and then had a very nice up move here, and then rallying, as you can see. And let's just go back to a longer term chart so we can see what it's been doing. And basically, you can see that we're trying to head back towards the highs seen here in August and October of 2021. Now, those were made around 0.35, and that's what we're aiming for here. But if you look at the daily chart, we can see that basically we rallied above the previous high seen in July, but since then have come off again. So we didn't manage to close above that high. Can you see we just closed on that high? And then on the next day, we had this bearish pattern and then a follow through to the downside. So it is possible that we are short-term topping out here. Let's look at our relative strength index. We can see this high here corresponding to this high, and we can see our higher price high corresponding to the lower high here. So we've got negative divergence here with this high. So it is possible that Doge is not looking as bullish as the other cryptocurrencies we just looked at. So here again, you wouldn't want to jump the gun. What you want to see is a signal telling you that that view is actually correct. And if we were to fall through yesterday's low and the support line here, then the odds are more towards, well, they're higher for a further decline to be seen. So if you wanted to go short from a technical perspective, then you would probably have to wait for fall through Tuesday's low, which was made around 0.2574. Because that would mean we've broken through this support line. It would mean that here, because of negative divergence, we had a false breakout to the upside. And in that case, we could slide again. But even then, we have support coming in around the mid-August high and also the late August high. So there's quite a bit of support. So I'd be surprised if we were to sort of come off very sharply here. But you don't know what's going to happen next. Now, unless we fall through yesterday's low, so as long as we don't do that, the trend is your friend. And you can still see here, yes, we've had a very nice uptrend. Yes, we failed the previous high, but this might just be a short-term consolidation in that uptrend, and that might just resume in the near future. So basically, the chart pattern is still bullish as long as we stay above Tuesday's low. Now, I also have a question about XRP, always an interesting one to watch. And you can see here that XRP is basically also looking not as bullish as Bitcoin and Ether we saw earlier on, because what we've seen here is interesting also from a technical perspective, in that we broke through this accelerated downtrend line. And that was actually a proper downtrend, because here we had 3 touching points. So I need to change this one to our solid line. And you can see here that we broke above there and above the relative high here. So that was bullish, but now we're seeing a pullback. Now, does that worry me? No, it doesn't at this stage. Why? Because quite often when trend lines get broken through, we do see a retest of the trend line. You can see here we did that on Monday. And basically, as long as you hold around that trend line, that breach trend line now, which has become, because of inverse polarity, a support line, well, the trend here is still bullish and the trend line break is still valid. So for me, basically, as long as we stay above the low seen on Monday, and perhaps even slightly lower lows, let's say the 9th of September low, to give ourselves a little bit more room, well, we could even take this one. This is more important because basically from there we had this big rally. So let's say the low going back to the 6th of August, as long as we stay above that low at around $2.90, basically, for me, the trend line break is still valid and it's likely to continue, or more likely to continue than for us to revert lower. Now, if we therefore don't fall through that $2.90 low, we might retest this high seen on Saturday, on the 13th of September at 318, or a little bit higher than that. And a break above there would take us to where? Well, basically, if you look at your chart, what do you look at? Well, basically, you go to the left of your chart and you see where the previous highs were on the daily chart. And you can see here we've got a cluster of these. So if I just make this cluster a bit clearer, we can see where the resistance is. So quite often resistance isn't just a level, it's an area. And you can see here we had in this area here, made up of the highs seen on the 28th of July, the highs seen on the 7th of August, 8th of August, 9th of August, 11th of August, and 13th and 14th of August. You can see all of this cluster here making up this resistance area. And that resistance area is basically between sort of $3.33 and $3.38. So that would be our next upside target if we were to manage to rise above the 13th of September high. So you can see how technically I'm building a picture, and then I'm looking whether the underlying asset, in this case XRP, is going to do what I expect it to do. And if it doesn't, I'll react to that as well. But here, basically, as long as we stay above 290, for me, the picture is still a trend line break, still bullish, might take us towards this high here, and then a break above there should take us towards the next higher highs, where I just mentioned this resistance area here. Now, if we were to fall through the uptrend line here and also through this 290 low, where could we go to? Well, we'll do the same thing again. So in that case, what we've seen is a false breakthrough to this trend line, a failure at previous or just above previous resistance. We would then make that trend line, well, actually it's only got 2 touching points now. So it's a dashed line here. That would be a resistance line. And we would then expect us to fall to where? Well, basically what we would look at is the lows going back to the 3rd of August and the 1st of September. You can see how this area here acted as support from where we bounced back. So that would be our downside target area. But from a longer term perspective, because basically if you hold cryptocurrencies, a lot of people just hold them as an investment longer term. Well, in that case, basically, you can see here we've had a very nice up move since June of this year, and we're just consolidating ever since then. And basically, as long as we stay above these lows, the sideways trend is still valid. Obviously, you want to break out above this 8th of August high for us to leave the sideways trading range, in which case we could head back up again towards the July highs and even go higher towards perhaps the $4 mark. But right now, we're just sideways trading, and we are right in the middle of this sideways trading range, and not really much going on. I showed you the short-term technical picture, but longer term, basically, as long as we stay above these lows from August and September, the long-term uptrend here seen since the April low is still very much intact. So if you look at cryptocurrencies, you need to decide which sort of trading you're interested in, which sort of investment, I should say, you're interested in. We all know that they are unregulated, so you have to be very careful because you could lose potentially all your money. But basically, you want to see whether you've got strong trends to the upside or sideways trading ranges, because then you can adapt your trading strategies to that. So for something like XRP at the moment, you could mean revert trade because it's been in a sideways trading range for the last 2 months or so. Whereas here you can see Bitcoin has fallen through that support area we previously mentioned and then went down here. That acted as resistance, hit our low in September. But since then, we've been gradually rising and we continue to head higher. So here it's a more trending approach, because now basically also what we can see is that previous support area, because of inverse polarity, now acting as a once again as a support area, because here basically that's previous support area became resistance here on the 28th of August and the 5th of September. So now that resistance area, now it's broken through, should act as a support area again, which is why I'm keeping it on my chart. Because basically previous lows and highs quite often act again as support or resistance in the future, just in case if we were to come off here and went back, and if we were to come back down again. But right now, ahead of today's US Fed decision, Bitcoin and Ether still look positive, Solana as well. XRP and others are perhaps a bit more mixed. We'll see whether we get basically a 25 basis point as is priced in by the market, or as about 10% of people seem to think, we are going to get a 50 basis point rate cut. But either way, at the moment, we're pricing in, I think, 5 rate cuts before the end of next year. And that should, in theory, help cryptocurrencies rise even further.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat, come on. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
On my list here for you, and here we are. Let's have a look at the winners first, and we have NEO. Many of these, as you can see here, have that bracket 24 hours, and that is because here at IG we have already added many of these onto the 24-hour list so that you can trade anytime you'd like, really, if that is your cup of tea. Lumen Technologies is in extended hours, 2.7% higher. We also have Pinduoduo PDD heading higher, and Novo Nordisk as well, licking its wounds there. We know Novo has been pounded recently, but it's now trying to regain some of those losses, up 1.3% there. Right, blockchain, and also some of the related names to cannabis are also slightly higher there. Moderna hasn't uncrossed yet, so we'll keep an eye on that for you. Let's have a look at the losers list now. Pinterest rising to the top, but sometimes it takes a while before we get this start to shake out. And here we are. iShares Silver Trust. This is down 1.8%. We've got Hims and Hers as well, down 1.6. Monkey. Are you still in Hims and Hers? Beware if you are. And we also have Beyond Meat down 1%, and ASML. I wonder if Ronnie is aware of this. This is the US listed stock, down 0.75%. Eli Lilly, I hasten to add, this is of course on my diversification list, down 0.5% there, but I think it will prove to be more resilient than Novo in that space. Palantir Technologies down 0.5% there. Rich will be happy to know because I think he has shorted Palantir quite successfully recently. And we also have General Motors down 0.33%. Now, many of you, if you haven't read the write-up on Bloomberg about how GM is really suffering in the EV race here in Europe, please do have a read because it is actually quite fascinating taking a look at what GM is up against when compared to some of the other EV makers like Tesla and some of the European ones that we know of already, the Volvo and the Polestar 3s. So take a look at that. I think it's on Bloomberg. I'll post it after the show as well. Of course, it is a huge week. We've just done a poll early this morning. Rich also taking you through some of the things to watch out for when the Fed concludes its two-day monetary policy meeting. I'll be heading out after the show as well to do a short for you to tell you how to trade it, what to look out for. Bear in mind the comments from Jerome Powell likely to be more important than the actual event itself and what the central bank does. And here is my lovely, beautiful co-host.
Your
Rich.
assistant bringing you a nice coffee.
Oh, thank you. How did you know I needed this? Oh my
It's a good one this morning as well.
Yeah, I was just singing your praises about you showing all our viewers where to look when we get the Fed decision out later.
Yes. Shall we put that up on the chat, actually? We'll give you the link that tonight becomes live at 7 p.m. So you can click it beforehand, but it just goes to a page that shows like an error. But at 7 o'clock and 1 second, then it goes live. So we'll We'll get that up for you on the chat. Copy paste.
You're gonna do that as you have your traditional gusto or your with a glass of wine as you watch it change before your eyes.
So are you doing this radio recording today?
Yeah, I.
Yeah, so we've got to record a radio advert in the studio at 11 a.m. But then we've got from 12 midday to 7 p.m. to kind of wait with anticipation. What are you going to do?
I don't know, pace about, drink more coffee. It's going to be exciting. Friday, I think, is going to be even more exciting.
Yeah, you like your triple witching, don't you?
Ooh, and this
Or
time it's a quad. Yeah, it's a quad. And very helpfully, there is on the Tasty page, how to trade quad witching.
Ooh.
Yeah, which I'm going to put up right now for everyone to see. But it's very, very helpful. They've got videos as well. And there's also a step-by-step guide, but it is on the Tasty Live page. What else are you looking out for this week as I get that up, Rich?
Well, we were chatting, Ronnie and I were chatting about the chance of this being a reversal, a travel and arrive in risk assets as a whole. I even think gold could come off, because if the main moves over the past few weeks have been a dollar crash, gold going to the moon, and then risk on for Micron, Oracle, all these stocks taking us higher and taking the markets to new highs. So
Talk me through gold. I'm very interested in this. So why would it crash?
well, no, I don't think gold's going to crash, but I think risk assets as a whole, you've had this huge move. And I don't know if there's anywhere to hide. For once, I actually think cash could be the safe place.
Well, I'm glad you've said that, because you know the number of times I've asked Rich, has it happened yet? Has it happened yet? Even on holiday. I have cash on the sidelines waiting to be deployed.
Yeah.
Do you think it's going to be this week? Yeah, I know you said maybe today is peak, right? Peak for markets?
Yeah, I could completely see us getting a rate cut, the market going up 30 basis points, us hitting 6,700, and that's it. And look, there is a chance that could be the high of the year. It's not completely unbeatable. As I said on Monday, I was looking at my ISA and SIP, and I thought, my God, I'm up 20% for the year here. Like, I'll take the money. I'm very happy with up 20%. I'm not being greedy. So I've sold the vast majority of everything in my ISA and SIP. I then, my pension is workplace pensions with St. James's Place. Boo.
Expensive, the fees. I've got an account with St. James's too, and I'm looking to move the money out.
Yeah, I would move it. I'd be happy to move. But I was looking at that, and that's gone up 5% since I last checked, which was 2 months ago. Because they're doing this really annoying thing of moving from a web-based platform to an app. And my old login doesn't work.
Oh no.
So you've got to download the app, re-register for the app, and it's the wrong way to do things.
I have a real problem with their quarterly annual report as well. You can't easily actually see what the gain's been or where it's just they rely on you to do. And I think after COVID, they changed it so that you couldn't tell if you were flat or whether you lost money.
Right.
Yeah. So
We have to watch though. We've got a St. James's Place manager as one of the.
Speaking of which, I've got that page up. So if you swing over, you can see here, and it's a real easy what is triple witching explainer. How does it work, and how to trade it, more importantly. And to your left, you can also see quadruple witching on the menu bar. So just click to the left and you can find it right there. And it's just so easy. It takes you through it step by step. Key expirations and key considerations, those of you that are unfamiliar with quadruple witching.
So I've put the FOMC projections up on the chat there, so they are on the chat. Copy and paste that link onto your browser and then keep it for 7 p.m. tonight. At the moment, as I said, it shows the page doesn't exist, but that becomes live at 7:05 well, 7 o'clock and 1 second. And we're looking, what was your vote, Ange? So the end of 2026, tonight, in the dot plot, what will the average vote be? It was 3.6% in June. So that's, obviously, we've had a huge move lower in the market expectations. What do you think?
I went with 3.4, and I think, if I remember correctly, that was the majority. It became...
That's right.
Yeah.
Yeah, it was. Now, if we get 3.4 there, the market will absolutely crumble, because one additional rate cut since June is absolutely not what the market. So that will be 2 less than the market is predicting.
So I'm really concerned about this, because you're talking about, where is safety? Nothing's going to be safe if the market crumbles. Should I come out of even things like, I've got NATO still, at ETF.
Yeah, it would, or you can hedge it.
Should I come out of, I've got a bit of core weave still. I've got
that'll get absolutely
Hammered.
smashed. Yeah.
I've got Berkshire.
Yeah, but these are your long-term plays, aren't they?
Yeah, but should
Has
I
Berkshire
still...
bounced yet?
It has actually.
Right,
Slightly. It's
good.
bounced
Well
slightly.
done.
Yeah. Sarabi Gold has bounced a lot, has risen a lot. So should I?
All I'm saying for gold is that I think it'll go from 3,674 down to 3,550. It will then consolidate there, and then it starts its move to 4,000. So we're talking about 3%.
Okay. So my thesis, I was just halfway through. So the thesis is, and friends, if you want to poke holes, I love it when you poke holes in my thesis, because I want to know if I've missed something. If I sold out those, I'd be putting into the Solanas, and the XRPs, because we talked about liquidity a lot here.
Yeah.
And the thing is, it's all going to try and find a home, right? And there's already, been a huge, we've seen a slight move, gradually, but it's there, moving into that crypto space. This is not trading advice. I'm just asking for your view.
Oh, it's tricky. That is really tricky.
Well, that's a good one. Come out of core weave. Come out of core weave
Yeah.
is Richard's call. There is also something else at play here. So the interesting thing is, I've been canvassing many strategists out there to find out what they're telling their clients. And one of the interesting things that's coming out of this is that a lot of strategists, not naming names because they want to stay anonymous, is that the more pressure Trump puts on the Fed to cut rates,
Yeah.
the more likely, historically, that it's going to change the course of monetary policy, and it slightly makes for grim reading. So I'm going to put up a chart here, because I'm going to quote someone. I'm trying to zoom in so you don't see who it's from. But taking a look at the number of interactions between, the former...
One thing, the Donnie one asked earlier,
Yeah.
how many FOMC meetings has Rich been through? Mm-hmm. And so I did a calculation when I was out grabbing the coffee. It's my 150th FOMC
Wow.
tonight.
And it never really gets dull, is it? This is the thing.
No, I love them. This is my FA Cup final. Every sim I absolutely, it's my favorite event.
Phil is saying FA Cup's not that old. Yeah. So taking a look at the charts here, Richard Nixon met with Fed Chair Arthur Burns a total of 34 times in the second half of 1971 to try and influence him to cut rates and boost his chances of re-election. We're seeing Trump kind of doing the same, but guess what? He doesn't need to meet with Powell. He just posts on his platform, right? Social media platform.
Yeah.
But as you can see here, we're starting to see on these charts, the kind of economic impact of increased political pressure by the president on the Fed. So some things that are visible from these results is that it pushed short-term interest rates down in the 12 months after pressure was first applied. And also the problem is this all creates artificial inflation or inflation that wasn't there.
Yeah.
Are you concerned about this, McDonald?
I would be if you didn't have AI. Because AI is, in theory, hugely gives disinflation. So the theory goes that inflation goes higher now for the rest of this year, right? That is expected. Therefore, you're cutting rates into higher inflation. Doesn't make sense. But the inflation expectations are lower and are well anchored. Now, he has to say that tonight. He has to say that inflation expectations remain well anchored. That is a dovish tone tonight. And as soon as those words come out of his mouth, well anchored, the market will jump another 20 basis points. So that's one of the triggers to buy. If he moves away from data dependent, that's another one. That's a trigger to buy. And if he says that, you know, this, or he hints that this is the beginning of interest rate cutting cycle, anything like that, that's dovish, and that's a buy.
Nice. Do you know what else I'm looking at tonight? Meta. So Meta, for those of you that have a position in Meta, and it has been marching higher there, Meta is expected to double down on its AI offering of augmented reality products. So you might be interested in this. It's got these new smart glasses that
Terence has got.
Yeah, it's so cool. Did you try his glasses?
Yeah.
So Terence says he uses it and it's really good at telling you where your car is if you've forgotten where you've parked it. It can also, if you take a picture with it, it can also tell you, you know, what items are in the picture, although he hasn't really tested that out a lot. But the smart glasses that are going to be debuted at this Connect event are expected to be far cooler with more applications, but also costlier. So it's going to be interesting. This coming at a time, of course, when loads of augmented reality glasses makers are, you know, being faced with higher regulation, right? You've got the child safety and all that kind of jazz as well. So it'll be interesting to see what comes out of that.
Andrew McKelvey saying, McDonald, you're starting to sound like Fraser from Dad's Army. We're all doomed. No, I don't think you're not doomed. If you're up 20% in the year,
You're doing well.
you know, as people should be if they're invested. And then maturing. Yeah, no, that's a great point. Has the Portfolio and Art of Investing podcast considered this already? Diversification is supposed to flatten the impact of a sell-off. Now, there's 2 points there. The first being that we've got 15% in cash and we've got 10% in gilts. So that is 25% of the portfolio is basically, no, sorry, that's wrong. 15% in cash, 10% in gold. So 15% of it is in cash, waiting to be invested when we come off. Now, I personally, if we could change that today, I would take some out of the US shares because we got 20% in US stocks. I would take that out and just for 1 week, park it into a cash or cash equivalent. We can't do that because the Art of Investing we record tomorrow and the Fed's tonight. So it will be quite an interesting debate tomorrow on the podcast. Diversification is supposed to flatten the impact, but my argument is that every asset has now been pumped higher. So even gold is no longer safe or somewhere to hide.
Because it's gone up so far, so fast.
In certain circumstances. And this is a deleveraging. It's all the momentum funds. It's all the CTAs. Just a little reversal is going to cause selling. And that could be self-fulfilling, get quite ugly.
Yeah. I know loads of people who are already monitoring today and unwound lots of positions, and also ahead of Friday. A key thing that's just come through in case you missed it overnight. StubHub has announced the pricing of its IPO, and pricing at $23.50 per share, which is, if off my top of my head, pretty much bang in line with expectations. You a fan of StubHub? Producer Phil got conned.
For me, they're criminal.
Oh,
Absolutely
feels
criminal.
like I can tell you that because he bought tickets to a gig
Yeah.
and then got there and then found that Black Sabbath.
The whole thing has to be investigated as to how you can buy tickets.
Have you been conned as well? I've never used them.
We went into Britney Spears and we walked up to Wembley. This is my
Did not expect that.
ex-girlfriend.
Did not expect
when I was
that from Rich. That's like
25,
many things,
20.
but not that.
25, 26 years old. And we
Baby,
bought,
hit me one more time.
that's what she said. And then we bought tickets outside, and two tickets from a tout. And we got in, we got past the barrier, we got up to the seats, and we realized both tickets were for the same seat.
No.
So she had to sit on my knee for the whole of the performance. Which was, it was still Britney.
It was still Britney. Thank you for that really graphic image. On that note, we'll be covering most of that, and also if you want to find Richard's shorts, my shorts, all you have to do is go onto the platform, checking your drawers, and go to the short section over here on the menu bar, and you can find all of our shorts there. And we try to be as reactive as we can. Of course, it's very difficult because Rich, has a very active social life, given what we heard about Britney Spears. And so, it depends on whether or not we are going to be here.
Caught short, think that's a win.
Tomorrow, give us a sneak peek as to what the podcast is going to have in it.
We are, because of how important tonight's meeting is, we're going to go through what monetary policy consists of, why it's so important for the Fed to be independent, but we're going to look at their track record, and we're going to see how, or instances where central banks have got it wrong. Jean-Claude Trichet, for example, and how bad the consequences are of central bank. But basically, it's going to be a great explanation from, three guys sitting there that have been doing this for 100 years combined, of how to trade interest rate decisions, how to prepare for them, what to look at, and then, basically a cheat sheet to monetary policy.
Nice. And also, we are going to have a huge number of opportunities for you to send in your... many people have given us some ideas as to how to decorate our new studio.
Right.
So please send us more. We've had some recently. I think Sophie mentioned something about a shelf, but she's not giving away that shelf.
Yeah.
You've come up with some ideas as well.
I like a bit of neon. So a nice neon bull behind me, or a bear. Yeah, the bull behind Dan's, the bear behind me.
Did you see the one that I AI'd yesterday?
No.
So I AI'd. I'm going to try and get this up for you guys, if I can. Here we are. What do you guys think of this? Because I'm waiting on a quote. Just, they said I needed to give them something, right? So they could generate a price. Rich is very...
I'm not sure why there's a guitar. Let's have that as a bull.
Yeah, and a bear somewhere. But they just needed to price something up.
Yeah.
And so I gave them something that was quick and easy to do. So they should be giving me a quote later today.
Fantastic. Good. Right, let's take a last look at what the UK stocks are doing then, if the gents can get that up. Marks and Spencer's, we talked about earlier, has just rallied 3%. for some reason. Don't know why, but it was at 346 when we looked at it earlier. Now 356. And we got Centrica up there, Sainsbury's. So that kind of defensive theme that we talked about. And then the concerns on the downside about this tonight causing some dollar strength. Money is coming out of the miners. We're seeing Anglos, Antos, BHP all lower. And then BP also. So BP, maybe. I wonder if that's one to look at. Not sure what I think of the oil price here.
Yeah, that's more of a divvy stock for most people that I know holding BP. SAP shares also up more than 3%, rebounding from an 11-month low there. Quite a few moves due to upgrades and downgrades this morning. We have Inditex up 1.9%. This is the owner of Zara after UBS upgraded it to a buy. And Moonpig, do you ever use Moonpig?
Yes. That takes me back to producer Fred. Moonpig.com.
Yeah, he hated that advert. But Mini Cooper is a customer. Up 5.7%, Moonpig. Not bad for a card company, right? This is after the company says it is on track to deliver on its guidance.
There's a joke there. Yeah. Great. Right, good stuff. It is time talking about the art of investing. We are going to show you last week's episode, which includes a guest appearance from Sophie Cocker.
Yes.
And it's not that one.
Oh,
they haven't put one up for a week.
Okay, because it was her debut.
So it's episode 9. Are we sure we haven't shown this one already? Okay, so you're getting episode 9 of the art of investing. Sorry, and that's coming up after the break. Angeline, good luck for the Fed tonight. Everybody, good luck. Just be careful. Do not go big. Do not go big on leverage. This could be quite a potentially volatile session, and even if it's up 1% and it looks like it's going to go to the moon, just be careful. One single phrase could turn things around and get very ugly very quickly.
Make sure you have your stops in place. It could be wild. On that note, we'll see you again tomorrow.
The bulls have been snorting and the bears have been growling.
And I don't want to get political about it, but hey, why not? If you tax people more and more, growth goes down.
Bull markets don't die of old age, they die of fright. And Liz Truss gave them a fright.
But someone's got to buy these bonds, because if you don't buy the bonds, the governments don't have enough money to invest.
There's going to be a lot of money wanting to flow into America, and that could mean the demand for US dollars go up and the currencies they're coming from go down.
The answer you should have given them.
Sorry, Mr. Chairman.
I'm sorry, but the answer you should have given. It doesn't even matter what this is.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 9 of The Art of Investing. Now, of course, this is the podcast brought to you by IG, the global investing platform. This week, we're looking at the risk of our model portfolio. Now, all investors can watch their portfolios go higher and higher and think that it's only blue skies ahead. But the best investors out there also know how to manage the risks. And just in case there's any turbulence in the weeks ahead, we are going to go through all the important matters that you should also be looking at today. That will come after the Spice Market Update.
Well, September is upon us, the dreaded month of September. Seasonally the worst month, which we've been banging on about for the last couple of months. So it's here now, and it's already started quite interestingly. The bulls have been snorting and the bears have been growling. And for the first week in a while, we haven't had an equity index hit an all-time high. But what we have had is gold hit a new all-time high, and it smashed through the previous high at about $3,500 an ounce. And silver, close on its tails, hit a 14-year high, which is great. On a less positive point, bond yields, particularly in the UK, the long bond yields, these are the ones further out, about 30 years out, actually hit a recent high as well, higher than we've had since 1998, I think, and Liz Trust.
And what happens when bond yields are high?
Prices go down.
It's as if we've rehearsed it.
CJ, what do you reckon on that? You're the bond expert.
I mean, I think we'll be talking about bonds a little bit later on as well, but it's really interesting that we've come in September and everybody's sort of woken up. Perhaps they've all come back from their holidays in some Greek or Italian resort and suddenly thought, what about bonds? And they look at bonds and they say, do you know what? These bond yields don't look that good given the amount of supply that is coming. And people are finally seeing that this is something they're going to have to grapple with. The key point really is too much government issuance, not enough buyers. Yields have to go higher to entice people to put money in bonds. And that's a competition for capital, which is going to, we think, get worse.
Right, now that's a new term we're introducing there. What do you mean by competition for capital?
Well, if you're sitting there as an asset allocator, if you're sitting there as an institutional asset allocator, but if you're sitting there at home looking at your portfolio, you're trying to decide where you put your money. And where you put your money will where you think the return will be greatest. So there's a competition for where you're going to put it. So if everybody thinks equities are going to go up 10% a year, like my friend Mark over there, then obviously bonds yielding 4% isn't going to be attractive. But someone's got to buy these bonds, because if you don't buy the bonds, the governments don't have enough money to invest and spend on public spending and all these other things. So in the end, you'd have to get bonds to a level where people want to buy them. And that's this competition for capital. The problem with all this is you get a bit of a vicious cycle, because you get higher yields means more borrowing. More borrowing leads to higher yields, and rinse and repeat. And that's where we're getting at the moment. And it's starting to appear a little bit concerning. Should we put it that way?
And that's what put the markets under pressure this week, you think, Spice?
Well, I think so. But there was also a little event happened as well. There had been a number of parties been appealing against the tariffs. And in the US Court of Appeal, one of those motions was actually turned down and actually said that the tariffs were illegal. Now, America's been getting about $30 billion a month now from tariffs in revenue. And clearly, if they can't get it from tariffs, the bond markets are going to have to pay for it. And that also could have added to this, maybe these jitters we've seen in bond markets, particularly in the US. Also this week, we had Russia, China and India, the leaders of those countries, get together in Beijing. Trump would have not liked that. But they're talking about trade pacts and how do they avoid basically doing trade with the US in as many respects, because they want to make sure their own countries and manufacturing are doing well.
Isn't it amazing that Donald Trump has managed to get these people to all combine together and to get the press headlines, which sort of suggests that China's trying to take on the role of being the most reliable country in the world, as opposed to America. I mean, it's for further conversation, as we've talked about already, about some of the risk premium that's creeping in, but it does seem amazing to have got to that stage.
And the picture of Putin, Xi and Kim Jong-un, that really is the enemy of my enemy is my friend.
Well, the Chinese do think very long term, and that's held them in good stead and, may well do again. Basically, we've had a lot of data, not particularly important data in the last week, but next week we're going to get, and tomorrow, which is Friday, which is the day this podcast comes out, we got a big one again. Remember, we talked about the non-farm payrolls, which spooked the markets a little bit a couple of weeks ago and pushed the odds of an interest rate cut in America on the 17th of September, the next Federal Reserve meeting, up to about 90%. We've got that number again this Friday.
Just to be clear, non-farm payrolls again, the higher the number, the better the economy is doing. The lower the number, the weaker the economy is.
And we get the unemployment rate out at the same time, don't we? And payrolls. Payrolls is quite important for inflation.
It is, but more importantly for inflation, next week, we've actually got consumer inflation expectations. So it's telling you and giving an insight to what consumers are thinking about the way inflation is developing. And we also get some official numbers actually on inflation, which is the consumer price index in America, and we'll get them in other countries as well. But America's the one everyone's going to be looking for, because that's the markets are all looking, equity markets particularly, are looking for now a falling sort of set of interest rates as inflation comes to a peak. One other thing I'd mention on that front, we've had very little talk this week actually about who will be the next chairman of the Federal Reserve. Now, when Trump got involved a couple of weeks ago, that did disturb markets a little bit. We knew that this guy, Chris Waller, who already sits on the Federal Reserve, is the firm favourite, and he remains a firm favourite. But an old friend of CJ's, David Severos, from Jefferies,
really?
yeah, the strategist
Wow.
from Jefferies, is now second favourite.
Oh, wow.
Wow, yeah.
He's
74.
He's very good. I'll tell you, he's extremely good. He's one of the most successful investors that I've ever seen operate, and he's been very, very good at calling equity bonds and how they're all going over the past few years.
There's also been one other major event in the last sort of 24 hours, and that is that the antitrust case against Google, the Americans were sort of accusing them of having a monopoly in search engines, because obviously we all use Google, we do. That case was thrown out yesterday. So Google shares are up 9%. Apple shares, Apple get $20 billion a year from Google as payments so that Google can put their Google Chrome search engine on Apple products. They get $20 billion a year. So Apple shares are up 3%. But most importantly, Google are up 9%. And that's good for the technology companies, because otherwise they'd have to start breaking these companies up and spinning out, for example, the search engine part. And part of the reason they're doing that is now because we're seeing a very fast growth in these other search engines like ChatGPT and Perplexity and some of the others. So basically, the judge ruled that because new competition is coming in, actually that monopoly that Google's had for so long in search engines is not going to hold for long. The shares went up a lot. They went, like I said, 9%. It's huge for one of the biggest companies in the world.
We've added in a couple of risks there on the outlook of the economy and what's happening in geopolitics. So what better week to look at the risks of our portfolio? So why don't we start with this mix of bond to equities to commodities that we touched on last week? How are you feeling about that at the moment?
There's a couple of parts to that question, and we'll deal with them separately, I think. First of all, bonds to equities. As experienced bond investors, we all are now, given our teaching on bonds and the vision of Mark standing on the sofa here with Rich to show what the yield curve looks like. There are two real types of bonds that we should be thinking about. One are shorter dated maturity bonds. Remember, these are maturity bonds that maybe only have 3, 4, 5 years to go till maturity. And what's dominant for them and their performance is where are interest rates. So they can be thought of as quasi-cash. They're important to think about in the portfolio. They're not really taking any risk, though, in having those. So let's forget short-dated bonds for the benefit of what we talk about. Now let's talk about longer-dated bonds. So longer-dated bonds are 25-year, 30-year bonds, 20-year bonds, long time till maturity. Their returns are driven by a number of factors: inflation expectations, the amount of issuance there is, likelihood of repayment, somebody not going bust, and those similar types of concerns. Now, as I've been saying for a few weeks, longer dated bond yields need to rise to reflect where inflation is in the world and this issuance that is coming from all the main governments of the world. It's particularly high in the US, but it's also very high in the UK and across the whole of Europe. Japan is enormous as well. And so we have now got a situation where lots of governments are trying to borrow money, and that's making this competition for capital that we just talked about start to get a little bit difficult.
In fact, it might even come in to mop up all this spare cash on the sidelines that Mark keeps on talking about every week.
If it gets high enough, that's exactly what will happen, because people will sit there and they'll say, look, I can get 4% on my cash, but maybe I can get, I don't know, I'm going to put a finger in there, say 8% on my long bonds. Why don't I do that? So, that's why this is important. Now, you need to also remember a fact, something we talked about before, which is that the US has a massive current account deficit as well as its budget deficit. Now, when I say massive current account deficit, that means that it imports far more than it exports. And therefore, what it needs to do is attract a lot of money into its markets to buy its debt. And that's got to come from overseas people. And the problem is these overseas people are starting to think that maybe China, India and others Mark was talking about them earlier, are safer pairs of hands than maybe Donald Trump and what Donald Trump is saying to them. So what you see then is less people wanting to buy longer dated bonds from the overseas investor. So therefore, the competition for capital, we come back to that phrase, is between where will US retail investors, where will the man on the street buy bonds compared to where equities are now?
So it's not just a competition between different asset classes, but a competition between different countries who all are issuing all this debt as well.
Overseas governments all are trying to borrow money. Whoever's the highest maybe gets theirs some first. Whoever's last maybe suffers more. So there's this problem out there that there's a lot of people wanting to borrow money. There's a lot of people wanting to buy equities. There are a lot of people who want to buy bonds, and therefore bond yields will have to go higher in order to get that issuance away. So in my opinion, the pressure on long bond yields is to go higher. Higher yields mean
Lower prices.
And therefore, I don't want to hold any longer dated bonds within my portfolio.
Isn't it scary that the UK 30-year bond yield, so go out 30 years, if the government want to borrow money for 30 years, in the UK, they have to pay investors 5.75%, 5.75%. The American government only has to pay 4.9% for 30-year money. Now, that's interesting for me. What does it say about the UK? Why do you think we're so different in yields that far out?
There's two answers to that question, Mark. The first one is the US has a thing called exorbitant privilege. What that actually means is because the dollar is the reserve currency of the world, and there's so much business being done in dollars, so many people have to have dollars, that those dollars have to find homes from time to time. So there's more of those will stay in the US. So it means their bond yields are more protected than other governments when it comes to the yield level which they get to. So that's the first answer. But the second answer, and I'm afraid it's an answer that we need to be aware of, and we'll be talking much more about over the next few weeks coming into the budget, is we have an inflation problem here. We have too high inflation. We're not seemingly doing too much about it, apart from cutting interest rates. Don't really follow that. So that's not good news. We have a massive public sector borrowing in this country. So we have the government trying to borrow more and more money all the time. And their only answer is to, and I don't want to get political about it, but hey, why not? All they want to do is to tax people more and more. If you tax people more and more, growth goes down. Growth goes down. Money coming in goes down. You need to bridge this gap. You have to put taxes up again. And you keep doing this, and it's a virtuous circle until something goes wrong. And I'm afraid we've got to the stage where people are getting a bit worried about it. It's fine for me to join in with everybody else, but that's not what this sort of podcast is. This podcast is about where do we make investment decisions. So I want to go back to when I was a young lad, if I can remember back that far.
Gosh, many years.
When I started...
Cut to black and white.
When I started trading gilts, because I traded gilts for 15 years, all the time. That was my one job. And so we had to look at the long-dated end of the gilt market and say, where do long-dated UK government bonds offer value? And we developed a framework. This is not an exact framework. This is just how we did it. Take it or leave it. Let's just share it with everybody. So the first thing is, the first part of that framework, there are three parts. One, what is the inflation expectation that you think for the market? The second one, what is the risk that inflation is going to be achieved? And the third one, a more difficult concept, what is the real yield you should expect on investment? So that is, what is the yield over and above cash you should expect to take money out of your pocket and put it in investment? Because obviously I can keep it in cash, I'm not taking any risk. So what's that real yield? And that's normally thought about as the growth rate of the economy. So if you can get a better return on something than the growth rate of the economy, it's probably not a bad thing to go and do. So let's look at those three elements in their own right. First one, inflation. We have an inflation target of 2%. I do not believe the MPC are actually running their inflation target of 2%.
That's the Monetary Policy Committee.
And thank you, Mark. That is the Monetary Policy Committee who has set a target of 2%. I mean, these are the same guys who gave us 11, 12 a year and a half ago. So let's not think that's baked in the cake. So I'm going to say, I think they think that 3's probably acceptable. So I'm going to say 3 as my inflation expectation.
How far in advance do you look and try and judge inflation? It's not last month's figure, is it?
I'm sort of thinking over the next couple of years, and we keep rolling that every month. It doesn't come closer. It's over in the next few years. So it's your medium-term view of where you think inflation's going to be. And I think about 3% is probably fair. Now, when I was a young lad trading gilts, we had then the risk premium. What's the likelihood you're going to get that right? And that would vary anywhere between no risk, because you were definitely sure it might happen, or, well, I'm not sure what these people are going to do. Maybe I've got to have a bit of extra risk premium. And that risk premium would vary between 0 and 1 to 1.5%.
Okay.
So I'm going to say quite a lot of risk premium, because we've got a government in charge who want to keep borrowing more and more money, then don't seem to be particularly anti-inflationary. There seems to be risks being developed. So I'm going to go. Remember, I'm going to try and be as negative as I can, as conservative as I can with this estimate of where are we going. So 3% inflation, 1.5% risk premium. That's 4.5% so far.
Now, risk premium is something we could do a whole show on, right? But in basic terms, it's why if you were going to lend me and Spice money, you might charge him 5%, you might charge me 10%.
You're too kind.
Yeah, it's my interpretation, given what's going on in the world today, of how certain I am of anything. So there'll be times I'm really uncertain, and there are times when I'm not very uncertain. I'm pretty uncertain at the moment. All the stuff we talked about Trump, all the stuff we talked about the world situation, the populism, all the other things that are going on at the moment, I'm not as sure where things are. So I'm going to go, you would expect me to say this, if I really want to say where am I going to buy something, I'm going to go for the highest I possibly can. So I'm going to go for 1.5. So 3% inflation, risk premium, 1.5 gives me 4.5. What's the growth rate of the economy? Now, there's one for you. Now, I would suspect that the growth rate of our economy is somewhere in the region of between 1.5 to 2, maybe 2.5%. Let's say 1.5 to 2.5.
Yeah.
Okay. So now I want to be as difficult as I can in terms of where am I going to fund. So I'm going to add 2.5. So I've got 4.5 plus 2.5, which is 7%.
Wow.
So if I want to be really, really negative, I say long bond yield should get to 7. Now, if I think growth is 1.5, then that would be 6. So the range for me of where bonds offer value is between 6 and 7% in long gilts.
And at the moment, they're at 5.7, so not too far off.
And this week, they traded up to 5.8. So we're getting close to where I think we should start thinking about, guys, these things are going to start providing competition for capital. People are going to start saying, well, if bond yields are this level, why am I buying equities? Why am I buying some of these other products?
I think this is a yellow card for stealing a phrase from Jerome Powell. We've got to start thinking about thinking about.
Yeah,
out the Federal Reserve.
Yeah, so I think that's fair, but there aren't many shows where people will actually say, this is the range I'm looking for. We have at least given a range, and I would certainly be saying, if we saw bond yields above 6, let's put a toe into the water, and I'd look to be fully in my position, 6.5, 6.75, and closing my eyes, because my experience of bonds is that just because I put a number on it doesn't mean that's where it's going to stop, and it can get quite ugly and quite difficult. But if you've done your homework, we've talked about this before, if you've thought about this away from the emotion, when it gets there, you don't get caught up in all the, it could go to 9, it could go to 10 or whatever. You go in and you buy a position. So I will be banging the drum when we get over 6% long gilt yields for us to think and talk about it.
And markets being markets, we will get to 6%. It's not we will.
Looking forward to it, Mark.
I mean, the interesting thing is equities don't think of that like that at all. So equities look at the 10-year sort of time horizon for bond yields.
Okay.
So in the UK, that's only 4.85% at the moment, right? So it's about 1% difference. And in America, it's about 4.2%. So even lower again. And that's when you value companies, you have to put some sort of interest rate in to discount the future cash flows back to today's share price.
Just go over that again, sorry. So what am I discounting?
So you're discounting all the future cash flows from a company in your share price. And basically, the lower the interest rate that you do that at, the higher the share price will be today, because it's worth, you're getting all those cash flows and you bring it effectively forward in your mind to get a share price today. The higher the interest rate, then the lower the current share price is today, which is why shares prices go down when interest rates are being put up quite often, and ordinarily will go up when interest rates are falling, as they have been doing recently and are expecting to happen in the US in the coming weeks and months. So that's where the equity guys look. But where the equity guys sort of miss out on is this competition for capital. So an asset allocator like Chris chairs the meeting and says, bond guy goes, well, yields are now getting to my 6.5% where I want to buy them. And the equity guy goes, well, it's brilliant, because actually 10 years still, in a sensible range, and therefore share prices should go up. But the chairman says, hang on, we're going to put some money into bonds. And guess where we might take it? They might take it from equities.
Ooh, are
and
you
that's where you can
feeling there's a
sometimes
risk?
well, that is always a risk as an equity investor. So we have to keep an eye on what's going on 30 years out. But actually our day-to-day focus is what's happening in the very short term and in 10 years' time. That's what's called the risk-free rate for equity investors. They look at the 10-year yield.
It matters to the bond market, clearly, because there's a direct relationship. However, it doesn't really matter to equities until it gets to that certain point.
That's the key point.
Yeah,
You're absolutely right, Rich. The bond guys look in amazement over many years that equities continue to go up even when bond yields are moving higher, and don't know what the hell's going on and why is that happening. And then suddenly the bonds will get to a level where these asset allocators say, do you know what? We're now going to sell some equities and buy bonds, and then it will turn. We're not there now. We're nowhere near that sort of thing at this particular moment, because I still think, remember, equities, we've talked before in detail, but let's just rehearse slightly. We're going to get lower short-term interest rates probably. Remember, I'm talking about long-term interest rates. I'm talking about the longer end. The short-term can come down a little bit. That gives more cash to the system.
Yeah.
And growth is pretty good at the moment. Earnings are pretty good. So we're not worrying about that at this moment. I suppose where we would worry is if we, and dare I say it in a podcast, if we get to a Liz Truss moment, and when I say a Liz Truss moment, I mean a sharp move up in yields. Mm-hmm. And that's all I'm trying to say by that, because one day we'll have a podcast on what happened with Liz Truss and why the market did what it did and the fault of some of the organised institutions for not helping her out.
Shall we invite her on?
We could, but I doubt she'd listen to us. But at the end of the day, we don't want to see a sharp move up in yields, because if we see that, then that's when people start to think, oh, there is a problem here. So the steady grind we're seeing now would imply that the equity guys are going to be fine. The bond guys are just going to be watching their yields go higher and higher. But it will get to a stage where the competition for capital means people say, I'm going to buy bonds. And I'm just trying to put a level at where I think we should probably start thinking of a line to start buying the long end of the gilt market.
There's a great saying in equities, is that bull markets do not die of old age. So all you people think, oh, it's going to be bad because it's just gone up a bit. It carries on and carries on. Bull markets don't die of old age. They die of fright. And Liz Truss gave them a fright.
Are you interested in growing your portfolio with IG? When you invest at least £50, IG will kickstart your investing journey with a free share bundle worth up to £200. Just make your first investment into an ISA, SIPP, or a general investment account by the 30th of September. You'll also benefit from commission-free investing, as well as 4% variable interest on your cash. Other fees may apply. Terms and conditions can be found in the show notes or on ig.com/UK. Now, I think that gives us a great opportunity to move on and actually have a look at this week's performance in the portfolio, because this is the risk versus reward episode. This is when we get a chance to look at this portfolio and go through and see exactly how it sits. We don't think that there's too much of a risk of our bond to equity to commodity split at the moment, but this is looking into the future, isn't it? So
How have we done this week, Spice?
Well, it's been a good week. The portfolio since we started was up about 0.59% last week. At the end of this week, when we took the numbers, we're up 1.02. So let's call it 1%. We've had about a 0.4% increase this week. That's been led by our exposure to commodities. Now, if you remember, we had a big debate last week about we like gold, we like silver, but we had 20% or so of the portfolio in commodity areas. And gold has been the best performer this week, up 5.4%, our gold ETF, closely followed by copper, up 3.3%. And then the BlackRock World Mining Trust, which is up 1.8%. So all in all, that's driven this extra performance this week. On the negative side, the DAX, the German stock market, was down about 1.1%. The Japanese stock market, the Nikkei 225, is down 1%. And the Russell, which I put into the portfolio last week, is down 1%. So not off to a great start. But overall, that's why we have a diversification of assets in our portfolio, the combination of which came together and gave us an extra 0.4% of performance this week.
Can I say just a couple of things there? First thing, all decisions are joint decisions. So we don't go for it's your fault or my fault or whatever.
But mainly the chairman's.
Yeah.
Thank you.
Yeah, thank you very much. But the most important thing for me was when I was thinking about how the portfolio performed yesterday evening, and I hadn't got the numbers in front of me, I wasn't thinking about it. Equities have gone down a little bit. I thought we'd probably have had a slightly negative week.
Yeah.
And what this shows you is how that diversification, and in particular, and a little expression we're going to introduce here, is our split between fragile assets and anti-fragile assets. And when I say fragile assets and anti-fragile assets, I mean essentially assets that work when the system's doing fine and assets that work when the system's not doing well and we're starting to worry about geopolitical risk and all those some other things.
Right.
So what we found was because we had that high weighting, 20%, in anti-fragile assets, they moved extremely well when the temperature in the kitchen got a little bit hotter. The equities came back a little bit, but they didn't take away from that.
Absolutely. So if you look at our portfolio overall, you could get a split of about 78% in what we'd call the fragile ones, the ones that suffer when the world worries about big events like geopolitics or wars or whatever it happens to be. And the safer assets, the anti-fragile ones, are about 22%. Right. Now, some fall into both camps. So we've got the VanEck crypto and blockchain ETF.
Yeah, it's a tough one.
Now, you could say about 2/3 of that is fragile. So they like to go up more when the stock markets are going up, which is the biggest group of fragile assets are equities. But about 1/3 of that actually does well when they're not doing well. So they're the anti-fragile ones. But probably the biggest anti-fragile position we have in our portfolio is 10% in gold. Nearly all of gold becomes an anti-fragile. It helps you during big sort of risk-off events or sort of systematic risk that we see from time to time in equities. And the bulk of the portfolio is equities. For us, it's about 60 to 65%, depending on whether you want to include BlackRock World Mining Trust as an equity or whether you want to consider it a commodity. If you consider it an equity, then our equity position is in total about 65%. If you take BlackRock World Mining out and put it into commodities, then we have 60%, but we then have 20% in commodities rather than 15%.
And this is really all about knowing your portfolio, isn't it? And the risk assessment that it's very much worth doing. Knowing what's fragile, what's anti-fragile.
So what you're looking for when you are building your portfolio, you're looking for assets that aren't particularly correlated to each other, but you're quite optimistic about. Because if you have a number of holdings you're optimistic about, but they're not correlated together, it means they can offset and help each other when others are suffering. And that's exactly what's happened this week. I know we're banging on about it a bit, but it's really quite useful to see how the benefit of diversification has helped us this week away from equities and kept the show on the road and kept us moving in the positive direction.
So we're almost like a Tour de France cycling team, aren't we? Sometimes one's better at the hills, sometimes one better at the sprints. Not everybody's winning at the same time and all the time. It's some are better at some stages, depending on how risky things are, the geopolitics. But it's having the split that you know overall then you've got the safe stages as well as the times to be a little bit more risky. What do we actually think then, going ahead into the weeks ahead? Is there something that we'd want to do here, CJ?
I'm not recommending anything. We talked about bonds already, and I said that we're getting closer to a level where we might want to buy some long-dated bonds, but I don't think we're there yet. I'm still looking at September being a weaker month for our risk assets, for our equities. Basically gone nowhere so far in September, down a bit, up a bit. It hasn't really moved much. And therefore, I would prefer us to wait a bit. In my view of the world, I still think there's a chance that we might get a bigger correction to buy in equities this month. And if we see that, then I think we should take advantage of it, because that's been our plan all the way along the line. Set out your plan, set out your strategy. Don't let emotion get in the way of it. Unless your view changes, execute what you said. And that's what I think we should do.
CJ, not knowing for his virtues, but it looks like patience might be a virtue here. Do you agree, Spice?
I do. I mean, last week I obviously pushed for an increase in our equity exposure, which we've got, but I didn't want to sort of roll out all of our cash into equities, which is my instinct, by the way, because I am, respectful, as I've said before, of September, particularly being the normally the worst month for equities in the year. So we've got to be cognizant of that when we're making these decisions. And so we have. So right now, I have no recommendation to change the portfolio, because it's done what we wanted it to do in a very quiet, maybe negative week for equities. And we've actually outperformed by 0.4%. That's great. So if we got more positive about equities and got through this period of uncertainty, and we get into this interest rate cutting cycle, as I've talked about in the past, at the end of September, which is when we're expecting it to happen, then I would like to see us to begin to move equity rating up towards that higher level, which we've always said would be about 75% in equities for the long term, because equities give you a superior return of about 10% in total, about 6.5% after inflation, or 7% after inflation. So you want to have the bulk of your portfolio in equities. We talked about that in previous episodes. And there's no reason to think that that's going to be any different from where we are today.
Yeah. I suppose the other thing to add, where I agree completely with what Mark is saying, is that there's lots of data coming up, right? We've got the non-farm payroll numbers, which Mark talked about. Now, remember, they were the ones that set the trigger off for everyone going, we're going to get 5 rate cuts. So if they're stronger than expected, market might have a little setback on that. I don't think it'll be a long-term setback, just a setback on that. The same with the inflation numbers. If the inflation numbers come out a little bit higher because of the tariffs, people start going, I told you tariffs were inflationary, we can't cut rates. So there'll be plenty of volatility in September. But I just think we need to remember what our tactic is. We want to put more into equities, because the fourth quarter is normally a very good quarter for equities. So, let's take our time. Let's watch what happens. But so far, so good. 1% up since inception. I think it's not bad going.
That's right. Although we're on episode 9, we didn't launch the model portfolio until week 4. So that's 4 weeks of performance and up 1%. We're on track, because a reminder, our target for the year is
10%.
And we're not trying to hit the lights out. We're not trying for 15, 20% here. So spot on target. And we're happy with that. As CJ alludes to, we'll know so much more by this time next week. And we'll take informed decisions rather than just guessing before that, with a jobs number, with the inflation number, and therefore our outlook for interest rates going into the end of the year.
A few people have said to me, if we're so convinced that we might get a correction in September, why don't we have less in equities? Well, I've gone back to them and said, well, look, it's always sod's law that even if you get bad news, markets keep going up, because we could be going into a stage here where bad news is good news, ironically, for equities, because the bad news could mean that if the economies are slowing faster than expected, or unemployment is rising faster than expected, that means you're going to get more interest rate cuts. And probably the overriding factor for equities right at this juncture is the amount of interest rate cuts and how fast and how big they are. And that could mean that the bad news we might get could actually be seen as good news for equities. So we've got to be very careful, which is why we don't put everything into gold or to short-dated gilts as we've had, or cash. We have to have that balance just in case we're wrong. But we're respectful that over history, over 100 years, September has naturally been the worst month. So hopefully we'll get the opportunity.
The answer you should have given them
Sorry, Chairman.
Okay,
Sorry, Mr. Chairman.
just to be clear.
I'm sorry, but the answer you should have given. It doesn't even matter what this is.
You've got to be able to improve in life. You've got to try and learn and improve.
That's your 2 yellows, sir.
And that's what I'm trying to get to here. We did say right at the start that our neutral position, the position we're going for, was 75% equities and 25% other things. So the fact we've actually got 60% in equities, or maybe 65, depending on how you measure it, means we're actually below where we want to be in equities. So for those who say, why don't you sell some? We have effectively sold some.
We're running an underweight relative to neutral.
To where we think we should be as our normal course of events. I think sometimes underweight, overweight starts getting all sort of talk of institutional fund management, all that sort of stuff. I don't like that. So, but we're running under where we had thought our strategic position should be because of the weakness we expect in September. After that, if nothing has changed, we would expect to have full weighting in equities.
An interesting question here. Is there anything outside of what we have already talked about that you have been considering, maybe at home, maybe even in your own portfolios, that we touched on silver last week a little bit? That was a new thing we introduced. Are there any other areas of the world, equity-wise? Are there any other commodities? Or, what are your thoughts on other options that may come up in the following weeks?
If we believe that the US dollar is in a period of potential weakness, which Chris explained very well last week, why he thinks that's the case, then we have a position that benefits from that. That's commodity position. But another area of the world that benefits from a lower or weaker dollar is normally emerging markets like China, India. But if you invest in an emerging market ETF, then you will get a bit of all of those sort of areas in different degrees. If we really truly believe that the dollar is going to stay weak and going to probably weaken further, then emerging markets is something we have to probably think a bit more seriously about. Now, we have in a position because we've got 5% in India. So we're not we don't have anything. We don't have nothing in emerging markets. We have 5%. And actually, as a part of the world benchmark, it's not much more than 5%, frankly, the emerging markets. Yeah. But China would be an area I'd naturally want to think about. And maybe we could do a podcast looking at India versus China and some of the pros and cons of both, because obviously you've got the two biggest populations in the world. They've got between them about 3 billion people. So they're very important economies, increasingly important, but they're also quite important stock markets that we shouldn't ignore.
Excellent. You touched on US dollars there and the potential weakness. That takes us nicely into the first question of the week. And the question comes from a viewer that said, you guys spoke about GBP and US dollar in terms of one of your S&P holdings, but I didn't really quite understand. Do you mind going through again exactly if I buy in GBP or I buy a US dollar asset, where my risk is? CJ, do you want to have a go at explaining that?
Yeah. Mark did a very good explanation last week, and I'm going to just try and do it in a slightly different way. If we look at the three of us and we say that I'm sitting here with money to invest, I've got £1,000 to invest. Rich is sitting in the middle. He's the currency dealer. Nice. And Mark is sitting in New York trading in the Magnificent Seven or whatever he's trading in. Probably them, let's be honest. So I say I want to buy and put the money into Mark's fund. I give the £1,000 to you, Rich, and you exchange that at a rate of 1.34 at the moment, which gives $1,340 to Mark to invest in his fund. So Mark has now got $1,340, puts it in his fund and runs it for me. And he runs it for 2 years. After that 2 years, I decide his fund performance isn't good enough. And I decide to sell my holding out of Mark's fund, which has gone up 20%. He then sells that 20% for me, and he now has $1,609. So I gave him $1,340. Mm-hmm. He sells it and got $1,609. So in dollar terms, I have 20% profit.
Excellent.
But unfortunately, I'm not a dollar investor. I'm a sterling investor. So I now need to give that money back to Rich, who's still trading in foreign exchange. He's obviously not been that successful if he's still trading after 2 years in the same thing. Yeah. And over that time, the currency has moved up to 1.08. 0.75, which is a rise of about 30%. Obviously, Rachel's done a great budget and growth is very strong. Okay, it's a hypothetical, unlikely scenario, let's be honest. But at 175, he exchanges the $1,609 at 175 and he gets back to me £919. So I gave Rich and then to Mark £1,000 and he ended up with £919. I have lost 8%. So in this situation, the local market went up 20%. The US market went up 20%. So Mark thinks he's done a great job for me. By the time I've converted it back, because sterling has strengthened, I am now down 8%. So when I look at my valuation, I go, what the hell's happened here? And that's the currency piece. And it's vitally important for people. You talked earlier, Rich, about understanding what's in your portfolio, fragile assets, anti-fragile, that sort of thing. It's vitally important people nowadays realize the effect of foreign exchange. And why do I say that? If I go back 10, 20 years, back to my youth, maybe we'll go 40 years, but never mind. Most people in the UK, institutional managers, wealth managers, retail investors, they had a lot of UK equities in their portfolio. And so they didn't need to worry about currency too much. But over the last, certainly 10 years, people have moved away from let's invest in the UK market to let's invest in the world equity market. And not surprisingly, UK equities have been terrible. World equities have done very well, driven by the US. But what that's led to is a situation now with, you're an institutional investor and you're looking at your portfolio. Let's say you've got a 100% equity portfolio, just make it easy. 100% equity portfolio. 70% of it is now in US equities. So 70% of it is dollar based. Now, if we look at what's happened this year to date, UK equities have gone up about 15%. US equities, in local terms, in Mark's terms, where Mark's trading, are up 10 or 11%. But in UK terms, they're only up 2%. So if I'm an international investor, I'm looking, everyone's telling me how well I've done, but actually my US equities have only done 2 against FTSE having done 15. And that's why it's really important to look at what you've got in your portfolio. Look at those underlying investments. So that's why we've broken down our portfolio into individual bits. So you can see how we're allocating to each area rather than the global equity index. And you can see how much time we're spending thinking about our currency exposure and where it needs to be. And just one final from me on there, we have a sterling benchmark. Everything we should be comparing is about sterling. We want to make 10%. We currently have 35% of our portfolio get there or thereabouts in dollar assets. I think that's fine in the short term. I don't have a problem with that because, we've got the budget coming up, as we said earlier. We're going to do an episode on the budget, running into the budget. But it's unlikely sterling is going to strengthen much running into that budget. It's more likely it's going to probably give a little bit back. But over time, I believe the Trump factors we've talked about before, and where I think we're going to get to as a country, I can be more positive on sterling versus the dollar. And I will want us to reduce our dollar exposure. It doesn't mean we have to change our assets that we've got.
That's the key,
but it
isn't
means
it?
we hold them hedged back into sterling to make sure we don't have that foreign currency risk.
And if we can just put on the portfolio again, people can see if they go down just below halfway, there's the Invesco NASDAQ 100. Now that's in dollars. Underneath that, there's the iShares S&P 500 GBP hedged. Now, what have you decided to do there, CJ, when you took the decision to put us into the GBP hedged rather than such like the NASDAQ when we're in dollars?
We're controlling our dollar exposure. If we buy the hedged version, effectively, we're not exposed to the US dollar. So we've got some dollar exposure on NASDAQ 100, for example, as you say, is in dollars. But the S&P 500, which is an American index, is hedged back into sterling to try to limit the amount of exposure to the US dollar that we have got.
And again, we go back to the thing, you don't want to have all your eggs in one basket or be facing all one way just in case you're wrong. Because I would make an argument against Chris that if the US begins to grow as I think it's going to grow, 3 to 4% over and above inflation, and inflation starts to come down and interest rates are coming down, and all this new build of manufacturing, etc., to meet AI and all the tariff sort of impositions, there's going to be a lot of money wanting to flow into America. And that could mean that the demand for US dollars go up and the currencies they're coming from go down.
So we've got some exposure to India there. We've got exposure to euros with the DAX. We've got exposure to the Japanese yen. And it's just worth knowing and being aware of, isn't it? Because we certainly were back there.
Foreign currency should be a conscious decision. It should not be just this is what we normally do. So if you've got it, you need to understand you've got it. We're sterling-based investors. We look at returns in sterling. So anything you take away from sterling has got a currency risk. Now, you may be happy with it or you may not. You just need to know you've got it. And that's what I'm trying to emphasize here.
Now, as sterling investors and with our position in the FTSE 100, I feel like we could really do with a little bit of added expertise on the UK. What do you gents think about getting a guest on next week? Do you know from your time in the market somebody who would be regarded as an expert in the UK?
Well, I'm excited to tell you that we've got a gentleman called Charles Hall, who is head of research at a company called Peel Hunt, who are specialists in UK small, mid-cap and UK equities, basically, as an investment bank and a corporate broker and a stockbroker. And he has been badgering the government to try and improve the conditions for investing in the UK. So it's going to be fascinating to have him on and to be able to discuss with him, whether he's felt he's made any progress, whether anyone's listening in Downing Street or not. But we're going to get him in next week. Is Charles Hall. He's a great man. I worked with him back in the day, when all the banks were going bust during the credit crunch at Panmure Gordon.
I'm very excited to hear it because one of my pet subjects is how do we get more and more people buying UK equities? All I ask is we sit him over this side of the table because then we can hurl things at spicy.
Fantastic. We do have another question that we didn't quite get to them all last week. And this is a question that we've got in, and it is related to risk. So I've maxed out my ISA. I've also got a general investment account as well. Which one should have my higher risk stock investments in it? Should one be more income related? Should one be more for capital growth? It's a really interesting question, and I've racked my brains, and there's not an easy answer for it, is there?
No, there isn't. And, this is one of these questions that when you watch people on the TV, they say, I'm sorry, I can't possibly answer that question because I haven't got enough information. And I'm afraid in this situation, it is very difficult for us to answer that question because we don't know the individual's position, and where they are in their life, what their aims and objectives are, and all those sorts of things. But having said all that, we know that an ISA is a tax-free vehicle. So if you think you can make a lot of money in something and you haven't put money in your ISA already, then you can put that investment into a new ISA and you won't pay capital gains tax and you won't pay income tax on it. If you put it in your general account, you have maximum flexibility to take in and take out whenever you like. But of course, you have to pay capital gains tax and income tax. Now, the advantage of being in the general investment account is if you're wrong and you lose all your money, you've got a tax loss. But presumably that wasn't why you did it in the first place. So I'm sorry I can't be more helpful. Clearly, if anybody's got a better answer than me, then please say it. But it's really down to individuals' own positions and their own financial situation.
Generally, do you like to spread your risk across whether it's an ISA, a SIP, a GIA, or do you think of them differently?
Unlike the good fortune of our questioner, I don't have the capacity to have investment accounts, SIPs and ISAs. But if I had my choice and I had my time again and I went back to when I first started working, I would have built a portfolio every year in an ISA because that stays tax-free. This is not giving financial advice. unless you've got a massive pension, then these ISAs is saving £20,000 a year in, year out in a tax-free vehicle. If you did that, and a lot of people don't put £20,000 into pension contributions every year, they should probably put it in an ISA and do it every year. That's my own personal view. That's not giving financial advice, but that would be, if I had hindsight, that's what I would do again.
Excellent. Right, well, that is us yet another week, and no changes in the portfolio. We're going to wait and see. You'll have had the luxury of already seeing those non-farm payrolls and unemployment rates, and then we've got inflation coming up next week. So very exciting episode to look forward to, including our guest Charles Hall as well. Now, if you do have a question for us, then by all means, please send it in and we'll try to address that. The email address is
theartofinvesting@ig.com.
And also, if you have an X or Twitter account and you'd like to start something trending called #SackTheChairman, then please, by all means, go ahead. We'll see you next week.
We are back. This is Overtime. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan. Thomas Westwater in Chicago. This will be our new Tuesday lineup for a while, but rest assured, Mr. Vecchio will return just as soon as he's done figuring things out for a couple of weeks here. I'll let him tell the tale. I trust he will be overjoyed to share it. Gentlemen, how goes it as we get ready for this Fed meeting?
Thomas, I'm saying we get swamped. I'm saying we get slaughtered. I'm saying we get our beak jammed straight in the dirt. I'm saying this thing is ripe for a face pounding. That's what I say. I say the supernova's been driving this thing all the way up to September 17th. September 17th is here. You're going to get your rate cut. You know you're going to get your rate cut. No one's going to be surprised by the rate cut, but it's going to be a rate cut for the wrong reason. It's going to be a lousy statement. There's going to be concern about growth. There's going to be concern about jobs. There's going to be concern about tariffs, and the market's not going to like it. And this whole thing's going to get slaughtered. What say you?
Yeah, I mean, I think it's all about, the policy statement and the SEP. We know we're going to get 25, outside chance 50, outside chance 0, probably more than 2 dissents, 3, maybe 4. So, is more dissents better? Does it protrude uncertainty within the board? There's a lot of things going on. The labor market, we know that there's certain governors. Lisa Cook is more focused on the labor market versus other participants, but there's still this overhang of inflation. And then you got the dynamics within the labor market itself, the supply side with immigration, the demand side. So it's going to be a cut to stimulate, a little bit of demand. I think it's all about, is it going to be a sell the news event finally after we've gone pretty much up after months.
I mean, how can this not be sell the news considering the positioning of pricing going into it and the reason we're going to cut rates? I don't know if you said there's a Tom Keene over at Bloomberg was circulating a chart earlier that was showing the labor market participation rate for men going from like 85 to 6. Like, I just think that I don't see how the labor market is not going to become a problem because of the AI supernova. And I don't see how cost pressure is not going to become a problem because of the tariffs.
Well, so this is really the essence of what the dance is here. So take a look. I have the Fed funds futures implied outlook here, and we can see the market is increasingly cemented around a 25 basis point move. So this was a week ago, and this was a month ago. So you can see that what you're seeing is consensus build around this this cut, and the chance of a 50 basis point cut, you can see a week ago was higher, yesterday was higher, now is only 3.9 So the market is kind of cementing around what this idea is, and increasingly it's, look, we're going to get a standard cut. It's going to be a 25 basis point cut. I think Thomas is absolutely right. It'll be a question about the messaging. The SEP is, in my mind, the biggest thing. But of course, Powell is then also going to do a song and dance, and we're going to find out what that's all about. I think the interesting thing here is we can, of course, rattle off all kinds of things, right? We can go down the list and say, well, obviously, we see that goods inflation, while still lower on the whole than services inflation, it's also at a multi-year high. It's been going up for 4 months straight. We can see that the tariff thing is making its way into inflation. I mean, that's clear. We also see that the labor market is soggy. That's clear. The revisions were terrible. The previous number was awful. If we look at the revisions and the previous number together, we added 22,000 jobs. We revised the preceding 2 months down by 21,000 jobs. So we added 1,000 jobs? Great. Wonderful. Not good. So when we look at the sort of aggregate picture, it doesn't look good. This is where sort of the market's perspective on all of this and the clash between the Fed and that perspective is really big. Because the market sees all these things and goes, right, so you're going to have to cut a bunch more times. And the Fed has just not owned that. And there's a disconnect. Because even in that Powell speech at Jackson Hole last month, where he was waxing on about we need to start thinking about making a move and this and this and this, he does say risks to inflation are tilted to the upside and risks to unemployment are on the downside, and then says, look, we cannot allow one-time increases in price to be an ongoing inflation issue.
So how do you stop the price increases in services? Why are services prices increasing? Because it's not inflation related. So when you have a weakening labor market and services prices are increasing, do you think that's going to be a question mark that they address?
So this is going to be, I think, a very interesting part of it, because what we saw in the last inflation report was that core services inflation actually fell. Now, it fell only by a little, and of course, core services is a much bigger overall part of the economy than is goods. So if the economy is 70% service sector, give or take, then most inflation is going to be there just because that's most of the economy. But the directional impetus has been higher goods prices, lower services prices. So that gives you that sense that the economy is slowing. So, but you don't see it in the overall data. The Atlanta Fed GDP Now tracker, never mind that it's way too early to really make a call on what the GDP is going to look like for the third quarter. That data is not going to come out in a while, but take a look at the direction of the data. So just look at that green line there. What you see is that the tone of the data has been higher. Now, does that mean that the economy is reheating? The PMIs suggested. So that's a bigger inflation risk. It hasn't metastasized yet in the CPI data or in PCE, but you can see it. And so it's an interesting sort of thing. We heard in the minutes, we heard from Powell, they're still looking at inflation as the greater risk. So if they're cutting for the wrong reasons, if they're cutting because growth is weakening, that's one thing. That's probably the worst of all possible worlds, to Dylan's point. But
well, I mean, what I'd be interested to talk about is if this thing's going to come unglued a little bit, where is it going to come unglued?
Mhm.
Is it in the supernova stocks, or are they actually the most immune? Is it in gold?
I think
which
if
is
it's growth, so the reasoning here I think is hugely important. My sense is if it's a growth risk that has people worried, if the Fed essentially comes out and goes, here's all your easing, and by the way, here's more, and we're slashing our inflation forecast and our growth forecasts because, oh my God, are we ever in business cycle defense mode? I think the markets aren't going to like that, obviously.
But
And
again, where do you think that plays out? Is that in the Nasdaq?
well, so then the Mag 7s probably actually look a little bit better because they're probably more immune to a growth risk than elsewhere. And then I think sort of the place where you'd expect the most pain would be here in the Russell. These would, one would think these are the most vulnerable names to a business cycle turn. And if you look at where we are here, I mean, obviously we're at record highs for S&P and NASDAQ. We're not there on this. And we do seem to be kind of squeezing into a sort of wedge here, which can be indicative sometimes of momentum essentially squeezing in before it gives way. So if you look at this with a technician's eye, then what you'd say is, you know, here is a rising wedge. It's telling you that you're still going higher, but momentum is getting squeezed in. So the swings are getting hemmed up. And even though you're setting higher highs, you're not setting them on, you know, choose your momentum indicator. I like RSI because it's simple. And that this would be sort of a classic into a top sort of setup, but you would need confirmation on a break, let's say, through this line somewhere here. So if you end in the red by a meaningful margin tomorrow, then you get a real clean signal. If instead the way that the Fed disappoints isn't by going, oh my God, growth. If it disappoints by saying, you all have baked in 130 basis points in rate cuts from now until the end of next year, and we're still at 75 at best. So we're like half as dovish as you are, and we're not going to give you all this easing. You're nuts because the risk is inflation. Then the market is disappointed, but then it's a very different kind of a thing. Then I think maybe one of the more, well, I mean, certainly NASDAQ looks awful in that sense because the supernova arguably depends on there being cheap money to power.
Does it though? I'm not. I almost feel like the supernova is. I mean, this is obviously the sort of comment that gets sort of jammed in your face later, but
right.
I really feel like the supernova is a freestanding entity. I don't know how. I mean, I understand how housing or sort of oil rig development in the Gulf of Mexico or the building, new infrastructure, energy infrastructure, transportation infrastructure is very sensitive to the cost of capital.
I think there's two things here, and I agree with you. I think the supernova is freestanding, but there's, in my mind, and Thomas, weigh in on this, see if this makes any sense to you. There's the supernova, and then there is investment capital betting on the supernova.
Totally. I see where you're going. And
like the supernova is doing its thing, right? It's a freestanding thing. It's going, it's whatever. The question is how much of that is already in the price versus not.
And how much is sentiment around the liquid public equities that represent the idea of the supernova?
Yes.
How much of that really is just sentiment at the end of the day? Obviously, all of it is sentiment, but how much of that sentiment is how far detached from the reality is the sentiment, which is obviously the billion, million, $1 trillion question,
right?
And how dependent is that sentiment? Listen, the economy's slowing down. That's not a speculative statement. The Fed doesn't.
I mean, the Fed is saying it.
Yeah. So the Fed is not cut interest rates because the economy is getting hotter. Right? They're not like, oh, this thing's really heating up. We better reduce rates.
Yeah.
Like they reduce rates because they feel like inflation is under control, or they have some version of comfort with whatever inflation is, and there is evidence of slowing growth.
Yeah. Yeah. I mean, essentially,
I can see a world where actually the supernova does better, and the Russell gets annihilated, for instance.
It could be. I mean, if the Fed is going to try to thread this needle that way and basically say, because I mean, the critique is simple. What are you guys, nuts? Credit spreads are down. Stocks are at record highs. You're cutting rates?
Right.
Are you out of your mind?
Exactly.
So the Fed has to make the case that, look, we know what you see. We're looking further, and what we see isn't good, in particular for the labor market. So we need to squeeze one out here, or two, or three, to kind of make sure that we're looking far enough ahead. If they can't sell that,
what does a lower Fed funds rate do for the labor market?
I mean, ostensibly, it lowers the cost of capital and lets businesses have cheaper financing, so their cost structure doesn't encourage them to fire, but maybe encourages them to hire.
Mm-hmm. And which industries are the most capital dependent right now that are even possible to hire? Healthcare. Like, let's just look at where job creation is in the U.S. economy. It's in healthcare and healthcare related services.
And government, yeah.
And it's in the government. Away from those two things, I'm not sure that there's any job creation.
There hasn't been very much, no.
And the government is utterly price indifferent to the cost of capital.
As we've found out.
And it's not, and I would say that in the scope of capital or cost of capital sensitive industries, healthcare is pretty low on the list.
Yeah. Yeah. I mean, the argument that the Fed has.
You understand like the academic argument for why,
yes.
But I'm saying in this economy,
it's not a strong argument, but clearly the markets think that there is a business cycle downturn that's coming, which is why they're calling for all these extra cuts relative to what the Fed is signaling. For whatever reason, the market thinks, look, the tariffs aren't the inflation issue. The tariffs are a growth issue.
Mm-hmm.
And whatever inflation comes of the tariffs, we don't have to worry about that being stuck because it's going to be so terrible for growth that the tariffs will become
the argument is that the catalyst for the rate cuts is the tariffs.
It seems this is what the
tariffs are a growth headwind.
It seems this is what the markets think, especially after the first 6 months of this year gave us the weakest consumption in 5 years. And the reference point on that is the first 6 months of 2020, which is the COVID lockdown.
Mm-hmm.
I mean, that's weak. That's weak consumption. Thomas?
So, I mean, we've known a lot of this, and we know the Fed is going to cut more and more as we get closer to it. If you look at the Mag 7, it's sped up. It's had its best month since May. If you look at the Russell, it's slowed down a little bit. So I think, if you're going into it with the view that the Fed is cutting because of a weak labor market, I think you see the Russell having a negative reaction, and the Mag 7s just keep doing what they've been doing. Because it's not driven by a growth in the labor market, it's driven by investment and this sentiment.
Mm-hmm.
And the rate of change of the AI adoption rate.
Right.
Yeah.
So I don't know if you really change anything that you've really been doing, if it's been working for a while. I'm not sure. I mean, that's a question that's going to be answered tomorrow. But you also have to account for the political pressure that it seems more likely by the day that there's going to be more influence over the Fed from the executive, especially next year. Moran is appointed, he'll have a vote.
He's
There'll
there.
be a
He's going to
dissent.
vote. He's going to vote at this meeting.
From what I've seen, legal scholars are pricing in more of a chance of Lisa Cook ultimately being able to be removed than it was just a couple months ago, even though an appeals court, 2-1 decision.
Yeah.
I think the groundwork is being laid for ultimately for there to be much more political influence next year. And so the rate projections, if you're saying 3 this year and 2 next year, that might be undershooting it. Because the administration is going to want more.
Yeah, I mean, this is where this gets interesting. So if you look at what policy expectations have been doing, you can sort of see this setup, right? So this is the December 2026 SOFR future, so interest rate futures. The way that this is quoted is this is the price of the future. The implied rate is basically this chart upside down. So if you're expecting more cuts, this goes up, right? Because this is cuts and this is hikes. So the way you arrive at the implied rate is you say 100 minus whatever this quote is. So in this case, it's 100 minus 97.1, say. But what you learn here is interesting in the sense that if you look at what this is, right? So this is the start of this year. Notice how much like the upside down of the S&P 500 this looks until you get to here. So this is stocks running up into a top. If you look at the S&P, it's almost the perfect inverse of this. Then at the beginning of the year, you get this growth scare. This is where everybody goes, oh my God, the tariffs, business confidence is down, consumer confidence is down. So this is mid-February to end of February right here. And just to kind of make this the most clear cut that it is, that's this right here. So where rates start going down, this is where the S&P starts going down, and this is mid to late February here. So this is then something of why this disconnect exists. Everybody gets freaked out about growth here, so rate cut expectations go bonkers. More cuts, more cuts, more cuts, more cuts. Liberation Day, all the cuts, and then things settle. And they settle, and they settle, and the rate cuts start going away until here, mid-May. Obviously, stocks keep going. Rate cut expectations just get built right back up. So whatever the market sees, it wants as many rate cuts now, give or take, as it did on Liberation Day. For the most part. There's these spike highs here. But the market clearly sees a growth risk of some kind. And when you look at the way these rate cuts are set up, certainly, to your point, Thomas, there's a sense that after May, you probably have a new Fed chair. Before then, you have a couple new Fed governors. They're going to dissent, even if Powell is able to essentially hold the line until May. After May, there's probably a new Fed chair that's more amenable. But the rate cuts are expected well before May. I mean, it's just cuts, 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 all through the first half of next year. If you look at where things are baked in, they're relatively front-loaded. So the market thinks there's a growth concern of some kind here. Or at least that there will be one.
And obviously that's indisputable, and it's just perplexing to me that the U.S. equity markets are at or near record or all-time highs. Even the Russell's not far. I mean, none of these things are way off of a level, right? And yet the story is we're worried about slowing growth and rising unemployment. and so we need a rate cut. Well, if we're worried about slowing growth and rising unemployment, why are U.S. equities at or near all-time highs? How do you reconcile the different signaling? I'm not saying that any signal is even wrong. I'm not disagreeing with what you're saying the market story is. That obviously is what the market story is. They believe there's slowing growth and a rate cut is in order. But what's with the rate cut at all-time highs? And if the rate cut is in order because of a growth concern related to labor and overall, let's say, a demand slowdown, how do you reconcile the anticipated demand slowdown with a market at all-time highs?
I think in my mind, if you look at what we just said, we said that rate cuts receded from the outlook as the market was recovering until about here, mid-May. And here you can see the stock market kind of stalls a little ahead of the former highs, ahead of the spot where it broke down, and then starts powering higher. And in this space here, rate cut expectations are building already. And so in my mind, this is, oh goody, cheap money. Whatever bad thing happens, there will be cheap money to tuck us in at night. And so until you get the big, scary economic outcome literally staring you in the face, which ostensibly we haven't had yet. We've had some bad jobs reports, but it's fuzzy enough, like ISMs are going up, S&P Global PMIs are going up, this Atlanta Fed GDP Now thing is buoyant. Retail sales, for example, surprised on the upside earlier today. So until sort of the bad outcome, the bad growth outcome, you can see the whites of its eyes, as it were. The market's like, yeah, but cheap money, though. Cheap money's good. We're not going to spend the money on investment. If we look at the GDP flows in capital investment, obviously the hiring situation isn't good. You look at all of those things, it's not like people are going, oh, the money is going to be cheaper, let's run up the economy. So far, it looks like they're just running up asset valuations because the cheap money's got to go somewhere.
If you correct the growth fear now and the labor market stabilizes into next year, what happens when inflation starts going up because the labor market is strengthening in 2026? I think that's when the big sell-off comes. I don't think
that's
it's anytime
the biggest
soon.
question, Thomas. That's the question. I think you've hit it right on the head, which is sort of why I suspect that the Fed comes out and doesn't endorse all this dovish signaling in markets, because it has that thought. And it goes, okay, so let's say we get a cut or two in here and we get this soft landing on course. What happens when year on year the tariffs go into the inflation data in earnest? And then what? Are we going to be in a situation where we have to hike? We don't want to do that. So let's not cut a lot. Let's cut a little and go incrementally and wait and give ourselves as much time as we can in between things, in between moves. And that's, of course, assuming that the politics doesn't get the better of them.
So this could be usually when you make the initial policy move, it sets a course, subsequent regular intervals of rate cuts or rate hikes, whichever you're doing. This looks like, assuming Trump's political influence doesn't go exactly as planned, where he has much more influence. This looks like it's going to be a cut, and then maybe one or two more cuts, and then uncertainty starts to build if we continue to get cuts in 2026. Mm-hmm. So once the market gets over these initial cuts and thinking we're going to stabilize the market, then you're looking into 2026. So I don't see a big sell-off. And when I say a sell the news event on tomorrow's rate cut, I mean a small dip, and then people start buying again, and we resume the bullish trend throughout the rest of this year. So I don't think that we're getting any big sell-off anytime soon. When I'm seeing, I see that coming next year, maybe as soon as May or June.
But you're saying it's an oh my God, inflation is real. The tariffs did cause inflation. They never should have cut rates, or they're going to stop short. They're going to stop short on more rate cuts because you're saying that you're going to get an April CPI or whatever. That's a beast. Or I mean, this is speculative, but some inflation data in the spring that's abominable.
I'm saying that's
the risk.
A risk that could happen.
Yeah.
And when right after you cut rates, and then all of a sudden you start seeing inflation go up, now you're in a position where, well, we just got done with the cutting cycle. Now we have to start hiking. The market is not going to like that.
No.
And that will come before the actual hikes are placed. It'll be when those rate hike expectations start building, or those rate cut expectations really start coming in after 2, 3, 4 cuts and saying we can't cut anymore. That's when the market is going to feel the pain, I think.
So, Thomas, if you're going to get a little bit of a pull back on this basis, right? If you're going to get a little bit of something where the market goes, right, okay, we wanted this many cuts. The Fed is not going to give us this many cuts because they don't want to front run this risk that sometime in the first half of next year, inflation goes totally haywire and then they have to look insane. So they're going to say, you know what, here's a cut. Maybe you get another one this year. Maybe you get a third one next year. For now, that's all we're going to tell you, which is what they did in June. So that was the thinking in June. So if this is what they do here, if all of this dovish rhetoric recently wasn't about our outlook has become dovish, it's, well, the calendar was running away from us. We only had the 3 meetings and we told you 50 basis points going all the way back to December of 24. We only have but the 3 meetings to do those in. So we're going to have to change our tune a little to tell you why we're going to go and do it, right? So we're going to have to give you a little bit of a dovish Jackson Hole just to, set the stage here, because we are at record highs and credit spreads are super narrow and there is no immediate capital pressure, as it were. So, and inflation is well above target. So why are you cutting? If they're going to sort of give you that same song and dance and go, well, I don't know why you all think anything has changed. We're just doing the 50 that we said. So we had to change our tune a little, but that doesn't mean that we're forecasting any more downwind. Do you think there's a pullback here in the bonds? And is that then a buy? Because, the trend here is up, but obviously we've gotten stuck a little. And last week, I was coming up on DTE, so I took it off and ended up sort of riding it up to here or so. And I think the trend still makes sense, but the question becomes, do you then, on the basis that they're not as dovish as maybe the markets want, is there then a bond sell-off because rates come up and then you get a mulligan somewhere around here?
Yeah, I think bonds will keep going up for quite a while, but they have room to pull back. We've priced in this as far as we're going to go, 25, and then Fed comes out, say they imply that we could get 1 or 2 more cuts, but they always hedge, right? They're saying data dependent, going month by month. So I think there's room for bonds to pull back a little bit here. I'm not going to be playing a super aggressive short bond position. I'm going to be looking more in the equity market. I think it's a little bit more vibe-ish, if you want to call it that, or sentiment driven than the bond market is.
Hear ye, we have coined a term.
Right, yeah. So yeah, I mean, I played bonds to the upside almost every time this year. I mean, last week I got out of long ZB position. It did what it did. It gave me the position for a good profit. Got out. Now it's, I don't want to say overextended. I want to say it's at it's properly priced as of now.
Yeah. Dylan, are you doing anything in the bonds here on the idea that the Fed is going to disappoint, not with holy moly growth down, but with actually we're a lot more concerned about inflation than you all thought?
No. As you know, I've been obsessed with the not thinking trade, which has been stunningly positive, obviously, on the Mag 7 side. I've allowed myself to go into all sorts of thought as over the last 24 hours. And obviously, anytime you start thinking, the obvious thought is this is absurd and must come back down. I was sort of, I guess, I defer to Tom and Tony from the conversation in the last hour, which is, wait for more information and make your decision after the Fed decision. As far as the bond itself is concerned, having a point of view on whether this is going to be, growth is slowing or inflation is worse than we thought, I wouldn't begin to speculate with my own money or your money as to what that's going to mean for the bond. So that's a long-winded way of saying no. I've done nothing, Ilya. And with the
let's
bond,
see if I can tempt you on the metals side, and I'll ask both of you. I mean, obviously, gold has stalled here a little. Silver has done a little bit more. It's pulled back here a little bit today. Moreover, it's setting higher highs, and the oscillator here, the momentum indicator, is not setting higher highs, which would indicate that there is some level of momentum loss. If we're going to get a Fed that disappoints markets, do we get a pullback here in your mind, Thomas, over the next day? And is that a buy, or is this one way to kind of get covered if the Fed disappoints? Stocks go down, maybe, but arguably so would these.
I'm long gold, so
me too.
The way I see it, what the Fed's going to do right now is we're getting the cut. They're going to forecast a couple other cuts. These rate cut bets are going to either stay the same or strengthen. There's uncertainty in the market, political uncertainty, uncertainty around deficits. While we have certainty that deficits are going up, we have uncertainty around the consequences of those deficits rising so quickly. So I think gold is, I'm kind of doing what Dylan's saying. I'm not overthinking gold. I'm just taking what the market gives me, and I'm staying long.
I'm doing the same thing. I sort of get the sense that gold is less about the immediate Fed outlook here and more about general uncertainty about what in the world is going on, including things like, is the Supreme Court going to strike down Trump's tariffs? And then what? And then it's like a mess.
Right.
And everything that we've spent 4 or 5 months attempting to benchmark is out the window. And it's all fog again. That seems like
a
recipe for gold.
Probably judicially, it seems legally that striking down the tariffs probably makes a tremendous amount of legal sense. And so it sort of comes into the debate between legal logic and partisan judges.
Yes. I mean, it'll be really interesting because these tariffs keep getting struck down, at least on the grounds that they were justified on. And now, at least the Supreme Court is going to rule quickly because they've said that they're going to issue an answer fast. But if they throw this out, I mean, does anybody really think that that's going to stop the administration from wanting tariffs? No, they're just going to go and try to look for other excuses.
But what is I guess you appeal to Supreme Court? Is that what the alternative?
I don't know that you can.
I mean, that was the whole point of the Supreme Court, was that that was the final court of appeal.
No, but you're right. But I think so the way that they've justified the tariffs, it sort of depends on the tariffs. If, let's say, you're talking about the aluminum and steel tariffs, they can cite one law and go, well, this is not a national emergency. This is not a risk to the sort of geopolitical posture of the U.S. What this is an unfair trade practice in a given commodity or in a given industry. And what we're doing is we're remedying that. And for that, you need justification. You need some sort of data. You need to be able to show it. What most of these tariffs are contingent on isn't that. It's that there is a national security emergency, and that's why we need most of these tariffs. That's the part that's getting overruled by the lower courts here. They're saying there is no national security emergency here. This justification doesn't work to let you have this authority.
I understand that. That goes. Every government, every dictator uses a national emergency as the basis.
Of course, it's classics. It's the classics.
101. I mean, that's what you do.
There's a great Netflix series called How to Be a Dictator. And it goes through some of the historical examples. It goes, well, if this is your set of circumstances, the way you'd be a dictator here would be like this. National emergency.
That's like the go-to.
Yeah,
like
step one.
Step 1 through 10.
Yeah. Yeah.
And so, it'd be interesting to see whether the Supreme Court is willing to consider the tariffs a solution to a national emergency.
Right. So my thinking is, let's say they get overruled on the national emergency. I mean, the administration is going to go and
says this is not a national emergency.
Right.
And then you're saying you got to go down the tariff list and be like, which one was implemented based on a national emergency?
Which is most of them.
And which one was implemented on some other basis?
Right. So all of the reciprocal tariffs, all of like the Liberation Day stuff, that goes away. And then the administration goes, well, can we sell it based on some other law?
I mean, isn't constitutionally, not to go all constitutional, but isn't constitutionally the Congress the tax policy maker of the country of the United States of America?
Which is why they have to get all of these tariffs essentially justified by existing acts of Congress and basically say, well, based on paragraph X of law Y, we can do this because
the authority was already granted.
The authority is granted.
The executive
blah, blah, blah.
branch has already been empowered based on this previous legislation to do this.
Yes, we can do this because Act whatever of some year gives us this authority on this basis. And what the lower court is saying is most of what you've done is on the basis of this national emergency power, and you can't show it, you can't prove it, there is no national emergency.
I would think the market loves it if the tariffs go away, even if it's a cloudy mess.
Probably.
I would think there's a bid across the board. I mean, my argument from the get-go is like, oh, well, the market's doing so well, the market's doing so well. And my counter, and I'm not my counter, but my follow-up to that sentiment, because obviously the market's doing very well, is imagine how well it will be doing without the tariffs.
Mm-hmm.
Assuming they just don't find some other legal mechanism or pull something out of somewhere as they've done.
Well, obviously, let's assume they are going to find something, but whatever it is, it will kick the can on the amount of time that it will take for the tariffs to take all the effects that we, and more important than us, the Fed and the C-suite and the S&P 100 and blah, 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 that it'll take longer for whatever the tariffs are to be implemented or take effect just because of the muddling of the Supreme Court ruling. On the other hand, if the Supreme Court says, no, it's all good, I would think I would think the market goes down on a Trump positive ruling and up on a Trump negative ruling.
What's interesting is that if there is a Trump negative ruling, then we've got to pay back the money collected. If it turns out the tax was illegal, then the government has to pay it back.
All the money has to come back out.
So the government pays that back after they collected it. Then do they reimburse all the importers that have paid that? I mean, I would assume they have
apparently, yes, from what I've read. which is incredible.
Remember, that's because the fee gets charged to the consumer, and then the company gets charged the tax. So I guess the money goes back to the company.
And then the consumers who have paid higher prices in places
probably don't get the money.
No, they don't get the money.
Which then
we get checks back.
Again, so it's all the more reason why the balance sheets bump up on all these companies that have just jacked everybody for tariff fees that they then later got refunded.
That might be how this ends up being good for markets. Companies get a bunch of money back, and it turns out their margins are better because they've already started to pass on these inflation costs. Consumers are now starting to eat them. Meanwhile, they get reimbursed for at least part of what they got shaken down for.
But of course, they'll lower the prices right away.
Of course, that's always happened.
Mm-hmm.
Wink, wink, nudge, nudge.
Yes.
Gouging. What's gouging?
It's just unbelievable. When is that ruling?
They said they would rule by October.
So end of the month, or end of next month, I'm sorry.
Yeah.
So there's 6 weeks in there. I also wonder, because we're kind of far afield here, but Volkswagen, Daimler-Benz, Louis Vuitton, all the big sort of luxury and auto importers could be interesting. I guess they're probably not liquid enough from a trading perspective to matter, or all the sort of domestic tariff beneficiaries, all those American car parts companies and whatnot. Anyway, the Fed meeting is tomorrow. We shouldn't get too far into my little Trumpian Supreme Court speculation.
Well, to your point on the sector performance today, it's not the best mix, but consumer discretionary is up, consumer staples up. So doesn't look like the market is terribly concerned. I mean, I guess the retail sales numbers helped, but if you were going to bet that basically consumers are going to get left holding the bag, I suppose you could look at XLY and essentially say, like, okay, consumer discretionary is going to get hit the worst if companies do okay, but consumers end up stuck with the bill. So I suppose you could look for a top here, but there hasn't been anything smelling like one yet. The best performing sector today, though, Thomas, is energy, up 1.68%. And if we look at what's going on with crude here, it has a pretty decent day for itself. What's going on here? What do you think this is all about?
I'm still in my iron condor between 60 and 67.5.
Mm-hmm.
Working beautifully over the past month. There's inventories have been rising in the U.S. the past 3 weeks. Inventories abroad, globally, have increased on net. The IEA has come out and said, we're going to go into surplus next year. Demand is obviously slowing. So what's keeping the market up? It's geopolitical tensions. It's Ukraine striking Russian oil refineries, export terminals, things like that. And even without that, the expectations are that Russian exports are going to drop with Trump in Europe now. Europe may be taking a more aggressive stance against the purchasers of Russian oil, because we've seen for the past 3 years, you can sanction Russia, it works for a few months, and then they find ways to sidestep the sanctions. There's 1,000 different ways you can do it. So now you have to go to the purchasers, which might be a little bit more effective. It'll be effective for at least the initial period. It'll be harder to sidestep things like that. So, we are going to see Russian exports continue to slow down a bit. A major global producer that's helping keep prices up. But I mean, we're holding that 60 a few times over the past couple months. So it really seems like the market does not want to give up that 60, but at the same time, these rallies have sold off. So we're kind of in a balancing act between, expecting global oil consumption to come down and the impacts of, tariffs on Russia, Iran, things like that, and everything else. So it seems like, I'm going to continue to play for a sideways oil market right here.
I mean, it certainly seems to be fairly priced-ish. It seems to be kind of wedging up against that center line somewhere in this sort of 61.50, 62 area on the November contract, and it's just kind of stuck there. We can see it kind of riding those rails. We've got just a few minutes left here. Let's go around the horn. How are you guys positioned for this Fed meeting? What do you actually have on, Thomas? And then we'll go around.
In terms of equities, I'm only long Tesla. I'm long gold, natural gas, neutral on crude oil, long soybeans, long wheat, long corn. I'm trying to get out of Alibaba, Iron Condor. Chinese equities have, across the board, just rallied quite significantly over the past couple weeks. So that's really the only position I'm not working out on. I have a short call spread on the Canadian dollar. It's pretty much unchanged since I put it on last week under Chris's recommendation, but that's about it. I think I'm going to start getting a little bit more position for a dollar rally maybe into next week.
Oh, this euro broke my heart today with this rally. I'm still in it. I'm still short it, but my God, that's annoying.
Yeah, the euro is it's got some resistance coming up.
Yeah,
but a strong move today. 120 maybe. If it got up to 120, I think I might try to short it.
Yeah, it's interesting. Just before we jump over to see what Dylan's got on here, if you look at the kind of big picture here for the euro, and might have to go to the continuous contract here. Here we go. 120 is no insignificant level. So if you look at where the recent highs in the euro have kind of petered out, going all the way back to 2018 here, this line, that's just about 120 and some change, kind of depending on when you get there, right? It's a sloped line, which is not great. This is why horizontal lines are better. But by the time you get up here, you're looking at maybe something like this, like 120.20, 120.50. But you are seemingly near some kind of an inflection point sort of thing in Europe. So,
and if the tariffs are ruled, unlawful or whatever, it's time for a dollar rebound, especially under that environment.
I would think so. I'm now on both sides of the dollar for what it's worth. I'm short the euro against these highs here. It's really annoying that both on spot and on the continuous contract, it's actually broken them. But on the current active contract, no. So I'm hanging on by a thread here. I am long the pound, which is not that ticker at all. There it is. When the pound broke this range here earlier this week, I got a little bit long. It's had a little bit of follow through here. So I'm on both sides of that. I'm long the metals, both gold and silver, but also short the S&P a little as of this morning. Just basically looking for a little bit of a buy the rumor, sell the fact kind of a thing. Dylan, are you just throwing more money at NASDAQ in perpetuity? Is that what's going on?
You know me too well, good sir. For all of my gibberish about worry and fear and this and that, I have owned and delightfully, with glee and delight. So the best thing that happened, not to go gloat, But that Google Gemini thing a few weeks ago just about made me as happy as a clam. Still like it. I owned it before that pop. I started when I know thinking. I'm real the religion of the thoughtless.
Mm-hmm.
Sort of late August there, right into that, actually right before that downdraft. Anyway, I love Google. Right now I like Amazon. I own Amazon. That's a recent arrival. So Google, Amazon, Apple. I don't own Tesla. Kind of wish I did, obviously, after what just happened. Don't own Oracle after what just happened. But I would say I love the unloved, although Google is now loved. But I love the unloved of the supernova stocks at this point, with Apple and Amazon at the top of the list. I've owned Meta for a while, but I don't even consider that a trading position, and it wasn't real. Like that's not that I bought that's like an investment position, so it doesn't really count. I have nothing else on anywhere else. I don't have Microsoft. I don't have the Nasdaq. I don't have Tesla. I don't have Rivian. Google was my friendly neighbor. The dollar is the bane of my existence.
Can I get you into some Rivian since the Tesla
you probably could.
If
you're going to
passed
anything, I think you probably could actually.
I mean, the IV rank here is not low, and so there's some room here. I mean,
even some put spreads among friends.
Yeah, I mean, if you think that basically the supernova is alive and thinking is your enemy, which we can't deny has worked better than anything else by far. At least in the past 4 or 5 months at minimum.
I mean, thinking has been, did you hear all the thinking I did today? It was catastrophic.
It's been although I am up on this year because the dollar bailed me out in the first half of the year.
You're plagued by thought.
I'm plagued by thought. My performance would be so much better if I, never mind fighting stocks, just didn't trade them and just was massively short dollar in the first half and then massively long bonds as I was in the second half.
But you got into
if
those
all I did was that
thinking,
and forgotten that Wall Street exists,
your number would double for the
fantastic.
year. Yeah, I know.
And with that, overtime is out of time. I'm going to try to lobotomize myself and forget that the stock market exists if it rallies in my face again tomorrow, which, as we know, likely. With that, we'll wrap it up here. We'll be back tomorrow to talk about what the Fed did and how painful all of it has turned out for all of us, because, of course, that would be the right Fed meeting to cause the maximum number of pain for all involved. Gentlemen, thank you. Don't go anywhere, anybody. I'll be back with a gruesomely exhaustive set of charts talking about this Fed meeting for macro money in just a moment. The day is finally here. We are less than 24 hours away from this month's fateful Fed policy announcement. We're going to unpack what the markets are telling us ahead of that announcement and how they're positioned and what that means for these asset prices going forward. I'm Ilya Spivak, head of Global Macro here at Tasty Live. This is Macro Money. And what we're going to do first is just take a look at the way the markets have been performing so far this week in the run-up to this major news. And then from there, see if we can't make sense of what is likelier than not to come next and take a look at what positions I have on to set myself up for what I think is coming. So let's go through here. There's a lot to get through, so we're going to move relatively fast. We have the performance today, not shocking in its sort of quiet and circumspect nature. We can see stocks kind of idling, the situation in bonds relatively muted, although we do get a little bit of a slide in front-end yields, ostensibly around the idea that we've had all this speculation around Fed policy in recent days. Last week, we actually had a little bit of a pickup in those yields here. We can see at the front end. And so perhaps the market's just evening out ahead of the event risk. The situation in crude oil still off on its own mission, a little bit of an upswing today, but price is still pegged near the middle of their multi-month range, and so not really going anywhere. Gold up narrowly, but a little bit soggier. Silver is down a little bit. The biggest mover really seems to be the dollar, which is absolutely shellacked today. This move of over 0.8% in the euro is a huge rally for something that is that big and that liquid of a market. And so big move for a one-day swing. The dollar likewise weaker against the yen. That's up almost 0.7%. And it seems to be lining up with the idea that the dollar has been relatively slow to fall, which we'll get to in just a moment, whereas the dovish positioning in markets has shown up elsewhere with gusto. We can see here yields have been falling. Last week it was a little bit of a pause, but before that we can see markets were clearly positioning for a more dovish Fed. But interestingly, the moves in the dollar were much more circumspect. In fact, when these yields had their biggest declines, the dollar actually squeaked out something of a rise against the euro, but on the whole sort of held up better than you might expect in this kind of an environment. And so a degree of catch-up certainly on the menu here today. If we look at the way the markets have behaved so far this week, pretty unmistakable. We're positioning for a dovish Fed, so yields are down on the whole this week. Stocks are up with the NASDAQ out front. Gold up, dollar lower, Bitcoin ultimately nowhere, and again, crude oil doing its own thing. So from the looks of it, we are very much positioned for the Fed to do something dovish, and that's what the markets are lined up here for. Now, as far as data is concerned, the only bit that we saw here over the past 24 hours, retail sales report, it comes in a little bit hotter than expected, 0.6%. The prior number revised up by a touch from 0.5 to 0.6%. So ultimately, we end up keeping pace, but what that ends up looking like is better results than what we initially saw reported for last month and this go round too. So for July and August, looking at the internals, probably the biggest standout here is that you get a big jump, a 2% month-on-month jump in non-store retailers, which is essentially e-commerce. And that's, let's call it, between 9 and 11% of the retail sales basket total. So not a negligible move. The biggest piece, of course, is motor vehicles. And here you can see things have cooled off, but that's after a very big jump in the prior month. We also have a relatively sort of healthy picture here on the whole for motor vehicles. Bit of a give back on durables like furniture, so high ticket items, but that's again after a surge in July. So on the whole, not the worst looking data by any means, but online sales and e-commerce, the standout, powering this better than expected outcome, seemingly. Now, The market is expecting the Fed to do something dovish all the same. We have here a set of expectations looking at Fed funds futures that have increasingly centered on a single 25 basis point rate cut. We can see here that yesterday the likelihood was lower by a touch that we'd get just one, and higher by a touch that we'd get a 50 basis point cut. A week ago, more so, the likelihood of a cut at 50 basis points was closer to 10%, and this was closer to 90. And what we see here is, as we've moved a week ago to a day ago to today, more and more certainty that we are going to get a single cut, less and less certainty that we're going to get a jumbo one. So the markets are pretty well anchored around, we're just going to get the basic version of what this is. And they've become increasingly convinced that that's the case over the past day and over the past week. The big disconnect continues to be what happens after this meeting, and that is probably the object of speculation. If the Fed delivers a 25 basis point cut, that is going to surprise nobody. But obviously, if we get anywhere on the extremes, the market sees 0% chance that there is no cut. So if there's no cut, obviously that would be a shocker. They see less than 4% chance that it's going to be a 50 basis point cut. So if it is, that's going to be a shocker. But if we're going to get the baseline 25 basis points or 0.25% cut, that's not news. Where there may be news is in what the Fed forecasts next, because this is going to be one of those quarterly meetings where the Fed changes, or at least reports on, maybe doesn't change, we'll see, but at least reports on their baseline economic forecasts. And this is not the Fed's forecasts, as it were. This is every member of the policy setting committee, the FOMC, gives their forecasts for growth and inflation and unemployment and the path of rates. Those get tossed into a hat, and a median comes out. First a median range, and then a median figure within that range. And that's what these forecasts are. And here there is a meaningful disconnect between what these policy officials have said and what the markets think is going to happen. Now, we can see here that the last time this was updated was June. The median rate currently is 4.4, so that the Fed called for 3.9 in 2025 means 50 basis points or half a percentage point in cuts, from 4.4 to 3.9. For next year, the Fed actually diluted its expectations and went from 3.4, that is another 50 basis points in 2026, to 3.6. That's just one cut. From 3.9 to 3.6 is a single move. 0.3 is obviously rounded off here to a single decimal spot from 0.25. So the market is at a single cut for next year, the Fed rather, was at a single cut for next year, and two cuts for this year. That's 75 basis points in total easing through the end of next year. Obviously, the markets are at close to double that. And that is really around a much more expansive outlook in rate cuts for 2026. Now, you might make the argument that the Fed is already looking at 11 basis points of a rate cut, a third rate cut on the menu for this year. So that's 50 basis points in and roughly a 44% chance of a third cut. If we start to look at the way the cumulative data works out, it's actually higher than that. It's a better than even chance that you're going to get that third cut. But the real big disparity is for next year, where the Fed clearly is erring on the side of 3 cuts, and the Fed only has 1. And so if the move itself is a given. If the 25 basis points is whatever, because we know that it's in the price, the markets are certain, no shock. Then the real question becomes, does the Fed move in any which way to endorse what the markets have or not? And does that occur perhaps in the summary of economic projections, or does it get talked about when Chair Powell takes the podium after the meeting for a press conference and explains all of what they do and what that signaling looks like? Now, why is this important? Well, we can see very clearly here that there's been something of a change in the relationship between stocks, in the blue line there is the S&P 500, and Fed policy expectations. We can see from the beginning of the year that they moved in tandem. So as we got stocks higher sort of from mid last year into the beginning of this year, we can see cumulative rate cut expectations are going down. And we're going from as many as 6 cuts down to maybe 3. Notice this is exactly what the Fed is giving us as of June. So we start the year, we get the tariff rollout, the markets go, oh, whoa, business and consumer confidence doesn't like this, and right around here, stocks start to break down. Notice that's also the spot where policy expectations start to get more dovish. We start to get more and more cuts until we get to this bottom here in early April, where both policy expectations bottom out and so do stocks. They begin to recover in tandem as the markets go, oh, okay, this isn't our worst case scenario here, it looks like. And right up to here, they continue moving in tandem. What's interesting about this is this marks for stocks a recovery basically to where they started, where the breakout was, here. And from there, we can see the subsequent build higher in stocks comes not with policy expectations getting less dovish, but with policy expectations getting more dovish. In other words, if there was a positive growth story in the stock market, you would think you'd need fewer rate cuts because the economy is strong. That is not what's on the menu here. Very, very clearly. In fact, the markets are saying, actually, you're going to do more cuts. And at this point, we can see we're almost back to these Liberation Day extremes here. And that's not exactly a story about growth positivity, but it can certainly be a story about cheaper capital. And so, if in fact we are going to get a Fed that does not endorse this expansive view of easing for next year, then perhaps the basis for much of what's occurred here since mid-May and through now is questioned. The dollar is at a similar inflection point. We see here that it started to bottom as early as July, and we're basically at that bottom here. We managed to hold up reasonably well as these expectations got more and more dovish. The dollar looked like it was attempting to bottom, suggesting maybe this dollar is ready to turn after an awful first 6 months of the year around these increasingly dovish expectations. But here, already as of July, we start to see things diverge. The dollar is attempting to stabilize. It's back basically at these lows here. And so a make or break point for the dollar here. And again, if the Fed doesn't endorse the expansive view of easing that the markets have, perhaps we get a dollar bounce. Why would the Fed not endorse the market's view? Well, we can see here that economic growth in the U.S. actually seems to be looking relatively better Never mind the actual GDP forecast implied in this GDP Now model for the third quarter. It's far enough away that this model is going to change many times over. Notice instead that what the green line is doing is trending from the lower left to the upper right. That is to say, the tone of the economic data that gets fed into this model as it comes out has been such that it has increased growth expectations. But of course, the flip side of that is it's also increased inflation risk. And so if we look at minutes from the last Fed policy meeting, this is going all the way back to the July meeting, notice a majority of participants judged that the greater risk was upside risks to inflation compared with downside risks to employment. This is the last time that the Fed decided policy. It does see that the upside risk to inflation and the downside risk to employment are both elevated, but it sees the inflation risk as the bigger deal. Moreover, if we then look at what Chair Powell said at Jackson Hole, he certainly pointed out that risks to the labor market are rising, and this is why the market is looking at that speech and going, yes, this was stage setting for the cut that we're about to see. But also, effects of tariffs on consumer prices now clearly visible and will accumulate in the coming months. It's possible that tariff-driven upward pressure on prices could spur lasting inflation. We cannot allow a one-time increase in the price level to be an ongoing inflation problem. In other words, if the economy is seemingly holding up and warming up, and inflation seems to be starting to build from these tariffs. We just got a CPI report last week that gave us the fastest goods inflation in years, while services inflation actually came down. It wasn't anything catastrophic, but nevertheless, for 3 consecutive months now, goods inflation has gone up. The most recent numbers had the biggest increase in that goods inflation, and the year-on-year rate in goods inflation is at a multi-year high now. So, to Chair Powell's point, the effects of tariffs on consumer prices really are clearly visible. And if the economy is in fact heating up, at the very least, in making the argument here, as Chair Powell does, that it's unlikely that tariff pressure is a lasting issue. That in fact, weakening of the labor market will suggest that the economy will more so slow than become inflationary as a consequence of the tariffs, because they will hurt consumption. Consumption is the biggest part of the economy, 68%. If you hurt consumption, you hurt growth. If you hurt growth, you hurt demand. If there's weaker demand, there's less upward pressure on inflation. And so in hurting the economy, tariffs will actually be disinflationary. So yes, there might be a one-off increase here, but, and this is clearly the gamble that the Fed is making in issuing these cuts, the greater risk will be to growth downwind. It therefore makes sense to look through that inflation. That's the Fed argument here. Clearly, the markets are in line with that argument, and more so because they see much more easing next year, ostensibly on the same bet that the tariffs will be more damaging and more disinflationary through growth than they are inflationary by amounting to a sales tax on imports. If the Fed isn't prepared to go as far as the markets are here and is looking at an economy that's warming up, seemingly, we can see here, and is saying, you know what? We're not going to over-extrapolate. Here's your cut. We'll own up to one more this year. And we'll see you in December for a reforecast. In the meantime, you only get one cut that we're going to extrapolate for next year because we just don't know what the inflation picture is going to look like because, again, we're more concerned about inflation than we are the labor market at this stage. If that's the tone, well, then stock markets are going to find themselves disappointed. Perhaps whatever part of this rally is contingent on this starts to give way.